Yes. So yesterday we were discussing the tax rates. We'll try to complete our discussion with respect to those tax rates. And then we'll proceed further. Today, before the first break only, we'll complete the capital gain chapter. So after the break, we'll move on to income from other sources. So you can keep page number 215 in front of you. Yesterday I had taken one example to make you understand these tax rates. We have actually referred the entire thing is referred here, but still we'll take one more example. Okay. So yesterday I have discussed example number 1 with you. So today let's move on to example number 2. Slightly numbers are changed, otherwise example is same. Income from house property is 6 lakhs. This is taxable at what rate? Slab rates. Long-term capital gain on equity shares, securities transaction tax is paid. This is covered by section 112A. This is taxable at flat rate of 10% in excess of 1 lakh rupees. And indexation benefit will not be given. Section 87A rebate is not available against this income. So your gross total income is 10 lakh rupees. From this 10 lakh, I am deducting income which is taxable at fixed rate. I am deducting the income which is taxable at fixed rate. So you know that there are 4 incomes which are taxable at fixed rate. Number 1, long-term capital gain which is covered by section 112A. Number 2, long-term capital gain covered by section 112. Short-term capital gain covered by section 111A, and winnings which is covered by section 115BB. So I have only one income out of this 4 income in the question. So I have deducted this 4 lakh. Now I am left with balance 6 lakhs. See, up to this point, the previous example and this example is same, there is no change. Now in the previous example, your actual investment in chapter 6A, section 80C to 80U was 7 lakhs if you recollect. It was 7 lakh. So we told that your deduction under chapter 6A would be restricted to the amount of income which is taxable at slab rates. Now tell me, in example number 2, your amount of income which is taxable at slab rate is how much? 6 lakh rupees. But your actual chapter 6 reduction, section 80C to 80U is only 4 lakh 50,000. So how much deduction you are going to get is 4 lakh 50,000. So 4 lakh 50 or 6 lakhs, whichever is lower, 4 lakh 50. So 4 lakh 50 is the amount of deduction under chapter 6A. Once you deduct this deduction of 4 lakh 50 from 6 lakhs, the balance would be how much? Balance would be 1 lakh 50. Balance would be 1 lakh 50. To this 1 lakh 50, we'll again add back those incomes which are taxable at fixed rate. In this example, I am having only one, that is 4 lakh, which is covered by section 112A. So my total income turns out to 5 lakh 50. My total income in this case turns out to 5 lakh 50,000. Now, I need to calculate the tax liability. For the purpose of calculation of tax liability, listen to me carefully. First of all, till now, have you understood this? Yes? Till now, have you understood? Yes or no? Please respond. Yes, okay. Okay. Let's proceed further. Now we need to do the calculation of tax liability. My total income is 5 lakh 50. This I will divide in 2 parts. Income taxable and My total income is 5,50,000. I'll divide this in two parts. I'll divide this in two parts. Income taxable at fixed rate and income taxable at slab rate. What is my income taxable at fixed rate out of this 5,50,000 is 4 lakhs. My income taxable at fixed rate is 4 lakhs. What is my income taxable at slab rate? It is 1,50,000. Now, before we actually calculate the tax rate, you know that what is the basic exemption limit? Basic exemption limit is 2,50,000. Are you all getting my voice clearly? Yes or no? Okay. So my income taxable at slab rate is how much? 1,50,000. What is my basic exemption limit? 2,50,000. So can you tell me what is the amount of basic exemption limit which I cannot utilize? I have an income of 1,50,000 which is taxable at slab rate. Against that, I have a basic exemption limit of 2,50,000. So out of the basic exemption limit of 2,50,000, I have utilized 1,50,000. 1,50,000 is exhausted. What I have not utilized is 1 lakh. That 1 lakh is called as unexhausted basic exemption limit. Unexhausted basic exemption limit. This 1 lakh unexhausted basic exemption limit can be adjusted against the income which is taxable at fixed rate. So what I am going to do, this 1 lakh negative, this unexhausted basic exemption limit of 1 lakh, I will adjust against income which is taxable at fixed rate. You already know that this can be adjusted against LTCG as well as STCG, but it cannot be adjusted against winnings. First of all, you should try to adjust against those income which are taxable at higher rate. So first of all, you will try to adjust against LTCG, which is covered by section 112, because that is taxable at 20%. Thereafter, you would try to adjust against section 111A, short-term capital gain, because that is taxable at 15%. And lastly, you will adjust against long-term capital gain covered by section 112A, that is taxable at flat rate of 10%. So I have adjusted this. Now I am left with 3 lakh rupees. Out of 4 lakhs, I should also reduce 1 lakh. Up to 1 lakh income is not taxable in case of long-term capital gain. So instead of 4 lakh, I should take 3 lakhs here. Out of 4 lakh, you know, long-term capital gain covered by section 112A is not taxable to the tune of 1 lakh rupees. So on that 1 lakh, there won't be any tax liability. So I should write as 4 lakhs is the balance long-term capital gain, minus up to 1 lakh, there is no tax. So balance is 3 lakhs. If I deduct 1 lakh unexhausted basic exemption limit here, I will be left with balance 2 lakhs. This 2 lakh will be taxed at 10%, that is 20,000 rupees, plus 4% I will have to pay health and education cess. That 4% health and education cess will be how much? 800 rupees. So my tax liability will be 20,800. My tax liability will be 20,800. Yes, have you all understood this very clearly? Yes or no? Yes. All these examples now I am going to send you. Yesterday I have formatted to a greater extent. Slightly formatting is pending. Wherever you might have observed, wherever the numbers are not updated, I will update and send you. Maybe today itself I will send you the entire file. This would contain explanation of lot of points, and it would also contain all the solutions. Now, one point I forgot to discuss with you yesterday, so I am trying to cover that point. In the section 54 exemption, if you recollect, we have covered note 3, note 4, note 5, note 6, note 7. All these notes are covered. But we did not cover the first note. We did not cover second note. Note number 2 we did not cover. We forgot to cover the second note. So I am covering this note number 2 right now. Listen to me carefully. I'll try to explain you the reason behind the provision. What is the provision right now and what was the provision earlier, why it was changed. That is what I'll try to explain you. Now, section 54 EC says what? Any person who is having a land and building which is a long-term asset, he has transferred that land and building and on that there is a long-term gain. Either he has to pay tax at 20% in section 112 or he can claim the exemption in section 54 EC. If he is having an intention of claiming the exemption, then he has to acquire the bonds. He has to acquire the bonds of National Highway Authority of India or bonds of Rural Electrification Corporation or bonds of Indian Railway Financial Corporation Limited or bonds of Power Finance Corporation Limited. So you can acquire any of these 4 bonds. These bonds which he is acquiring, for this he can claim the exemption. What will be the amount of exemption? Amount of exemption will be gross long-term capital gain compared to the amount invested in bonds, whichever is lower. What is the time limit for acquiring these bonds? It is 6 months from the date of transfer. What if you could not invest money within 6 months? Then you won't get any exemption. Do you have the facility of capital gain deposit account here? Answer is no, you don't have any facility of depositing money in capital gain account. Now, very, very important point I am explaining you. Listen to me very carefully. For explaining this point, I am taking an example here. This example is related to section 54 EC. Date of transfer of land and building. Date of transfer of land and building is say 1st March 21. Date of transfer of land and building is 1st March 21. So can you tell me, if you have transferred land and building on 1st March 21, there is a long-term capital gain. You want to claim the exemption in section 54 EC. What is the time limit by which you should acquire the bonds? If you have sold land and building on 1st March 21, then up to which date you can acquire the bonds? What is that date? Can you give me the date? Yes. What should be that date? That date should be 6 months from the date of transfer. So 6 months from the date of transfer is which date? Deva madam, it is not 31st July. How it is 31st July? March, April, May, June, July, August. March, April, May, June, July, August. It is 31st of August. Now, why she has given the answer as 31st? Oh, she has not given the answer as 31st July. She has given the answer as 31st June. Deva madam, are you understanding? You have a time period of acquiring the bonds. How much time period? 6 months period is allowed now. So from 1st of March 2021, 6 months period will expire on which date? 31st August 21, correct? Yes or no? Yes, okay. Now, so 6 months ends on 31st August 21. Now let me give you some numbers to make you understand. Say for example, I have sold land and building and the amount is 1 crore 26 lakhs. Full value of consideration. Expense on transfer is 1 lakh. Net consideration is 1 crore 25 lakhs. Index cost of acquisition is 25 lakhs and my gross long-term capital gain is 1 lakh. My gross long-term capital gain is 1 lakh rupees. Now, you want to claim exemption in section 54 EC. You want to claim exemption in section 54 EC. Therefore, you have invested money in bonds. On 15th March 2021, that is within 15 days, you invested 50 lakh rupees. You invested 50 lakh rupees. Just after one more month, on 15th April 21, you invested 50 lakh rupees. So your total investment is 1 crore. So you claim the exemption of 1 crore and your taxable capital gain is 0. Now listen to me carefully. What was the earlier provision? What the provision said earlier? Section 54 is this point I have not discussed with you yesterday. That is the reason I am discussing right now. So please focus. Earlier section 54 EC used to say that exemption under section 54 EC cannot exceed, exemption under section 54 EC cannot exceed 50 lakh rupees for a investment made in a financial year. Exemption under section 54 EC cannot exceed 50 lakh rupees for an investment made in a financial year. So here SSC has claimed the exemption of 1 crore. So income tax officer said that there is a maximum limit for claiming exemption, that is 50 lakhs. How can you claim the exemption for 1 crore? This is incorrect. I'll give you exemption only for 50 lakhs and balance 50 lakh will become taxable. SSC argued that read the sentence carefully, read the provision. What it says, exemption cannot exceed 50 lakhs for investment made in a financial year, in a financial year. What do you mean by in a financial year? In a financial year means in one financial year. In one financial year. My exemption cannot exceed 50 lakh if I make an investment of more than 50 lakh in a financial year. In one financial year, I have made my investment in two different financial years. The first slot of investment was made on 15th March 21. That is financial year 2021. Second slot of investment was made on 15th April 21. That is financial year 21-22. So I have claimed, I have invested money not in one financial year. I have invested money in two different financial years. Income tax officer says, no, this is wrong interpretation. This is the wrong understanding. 50 lakh is the maximum limit. You cannot claim exemption of more than 50 lakh if you sell one capital asset. So there was a fight between the department and the SSC and the case went to the court. Court referred to section 54 EC and said that it clearly says exemption under section 54 EC cannot exceed 50 lakh for investment made in a financial year. What do you mean by this in a financial year? It means for investment made in one financial year. So SSC is correct. He has made investment in two different financial years. So he is eligible to claim exemption of 1 crore. So decision was given in favor of SSC. But government did not like this decision. So government came out with an amendment in section 54 EC. Government said, now we are changing the language. Government says, exemption under section 54 EC for investment made in the year of transfer plus the subsequent year. Exemption under section 54 EC for investment made in the year of transfer plus the subsequent year cannot exceed 50 lakhs. Why they have not used all the subsequent years? Because anyway you are having a 6 months period to make the investment. So government says year of transfer plus 1 year. Combined investment deduction cannot exceed 50 lakhs. Have you understood this very clearly? Yes or no? Yes? Any one of you are having doubt here? So I have explained you that 50 lakh is the limit for claiming exemption. And that limit is for investment made in the year of transfer plus the subsequent year. Now, yesterday I took 3 examples now. If the bonds are sold within the lock-in period, then what? Then whatever exemption was granted, that will be withdrawn. There will be a capital gain on transfer of bonds also. All these things I explained you in 3 different situations, situation 1, 2 and 3. I told you not to write anything. So these examples I am having in front of me. Everything will be sent to you today itself. Don't worry about it. Correct, correct. Swati madam, correct. Your understanding is correct. So this we have completed. Now we are going to discuss section 48 proviso 1. Page number 183 in your textbook. Page number 183. You can keep page number 183 in front of you. First of all, I would try to explain you the reason behind the provision, and then we'll move on to understand the provision. We are discussing section 48 first proviso. Section 48 proviso 1. Now listen to me very carefully. There is an individual, Mr. X. He belongs to USA. Belongs to US. In other words, he is non-resident in India. He is non-resident in India. He is interested to invest money in India, in debentures, shares, etc. So he carries $1 lakh with him. He carries this $1 lakh with him and he comes to India with an intention to invest money in India and earn profit. He comes to India taking $1 lakh. Now, if he comes to India, he'll have to exchange these dollars for rupees, because he cannot make the investment in dollars here. He has to make investment in rupees only. So, for example, he came to India. While coming to India, he was carrying how many dollars? $1 lakh. When he came to India, at that point of time, $1 exchange rate was, say, 60 rupees. $1 exchange rate was 60 rupees. So how much money, Indian rupees, he will get? 60 lakhs. Correct? Now say, for example, there is a company here. Or this company shares are listed on a stock exchange. This company's shares are listed on a stock exchange. Now, Mr. X is investing 60 lakhs in this company. He is investing 60 lakhs in this company. After a few years, say after 1 or 2 years or 3 years, he is selling his investment. Invested 60 lakhs. Thereafter, he has sold investments. He has sold investments and he has realized 66 lakh rupees. He has sold investment and he has realized how much? 66 lakh rupees. Now he wants to carry this money to USA. But in USA, this Indian currency is of no use. So he'll have to exchange the Indian currency with the dollars. At that point of time, when he went to exchange the Indian currency with the dollars, the rate of dollar versus rupee exchange rate was $1 is 70 rupees. $1 is 70 rupees. Now you tell me how much dollars he will get by giving 66 lakh rupees. How many dollars he will get? Yes? Rupees 66 lakhs divided by 70 rupees per dollar. So he has received $94,286. He has received $94,286. See now what happens? Now he is taking these dollars to USA. Now in India we are saying him that you had invested 60 lakh rupees and when you sold off your investment, you sold off for 66 lakhs. So there is a profit of 6 lakhs. You pay tax on these 6 lakhs. You pay tax on these 6 lakhs. You invested 60 lakhs and you realized 66 lakhs. So there is a profit of 6 lakhs. On this 6 lakhs, you pay the tax. But this foreigner says, I have not earned any profit. I came with $1 lakh, whereas I am taking back how much? $94,286. So anyway, I am into losses. What is the loss? 1 lakh minus 94,286. $5,714 I have lost. How can you levy tax to me saying that it is a gain? This is ridiculous. I don't accept this. But income tax department says no, this itself is the provision. Why we should look at the dollars? Here in India we are looking at rupees only. You invested rupees, you recovered rupees. So there is a profit on investment. These foreigners went to the Prime Minister's office. Prime Minister was Mr. Manmohan Singh at that point of time. Not Prime Minister, sorry, Finance Minister's office. This entire bunch of investors, foreign investors, went to the office of Finance Minister. At that point of time, Finance Minister was Mr. Manmohan Singh. And all these investors explained this difficulty to the Finance Minister. Tell me why there was a loss to them? Because over a period of that investment, rupee has got depreciated. Rupee has got depreciated. So these investors are saying that we come with the dollars and we invest in your country. Whatever profit we earn now, that profit is exhausted because of depreciation in the rupee. You are not in a position to maintain your currency at a proper level. So it depreciates year after year, as a result of which in Indian rupees it appears to be a gain. But if you look at the dollars, then it appears to be a loss. So if you charge us tax, this is ridiculous. We will not come to India to invest. So Finance Ministry came out with a new provision, Section 48 Proviso 1. Here they said that in such situation, we would be calculating capital gain not in rupees but in dollars. We will calculate capital gain not in rupees but in dollars. Hence came section 48 proviso 1. Hence came section 48 proviso 1. So now we'll refer to this, look what is the procedure, and then we'll move on to our discussion with respect to practical problem. I have a practical problem on this that we'll solve once we complete this. Let us read this. Whenever a non-resident SSE, this provision is applicable when the investor SSE is non-resident, including a foreign company. Whenever a non-resident SSE, including a foreign company, brings foreign currency into India, he is bringing foreign currency into India. He acquires or he reacquires a capital asset out of that and then transfers or sells capital asset. Capital gain shall be computed in following manner. Point number 1, if the capital asset acquired is either shares or debentures. The word debenture by default includes the word bonds. So word debenture includes bonds. If those non-resident persons, foreign company, foreigners, they are investing money in shares or debentures of an Indian company, including the government company. The government company is also an Indian company. There is no point of explaining that. So where they are investing? Basically, they are investing in shares and debentures of Indian company. In that case, we will calculate capital gain in foreign currency. We will calculate capital gain in foreign currency. So we will convert the Indian rupees into foreign currency. We will calculate capital gain in foreign currency, and whatever amount of capital gain is there, that will be reconverted into Indian rupees. So point number 1, gain loss shall be computed in foreign currency. For that, you have to convert your sale consideration into foreign currency. In our example, sale consideration was how much? In Indian rupees, 66 lakhs. That 66 lakhs you have to convert into foreign currency by taking the average rate as on the date of transfer. Whatever is the date of transfer of that investment, of that date, you take the average rate. Average rate means buying rate plus selling rate divided by 2. If you go to buy the foreign currency, rate will be different. If you go to sell the foreign currency, rate will be different. So you have to take the average of buying rate and selling rate. So you take the average rate equals to buying rate plus selling rate divided by 2. So you take the average rate of the date of transfer. And convert this 66 lakhs into what? Dollars. You convert that into dollars. Also convert transfer expenses into foreign currency, taking average rate on the date of transfer. So expenses on transfer, sale consideration, expenses on transfer, everything should be converted into dollars, taking the average rate on the date of transfer. Next, convert the cost of acquisition into foreign currency. What is the cost of acquisition in our example? It is 60 lakhs. Convert that cost of acquisition into foreign currency, taking the average rate as on the date of acquisition. The date on which you acquired those shares or debentures of Indian company, you take the average rate of exchange of that date, buying rate plus selling rate divided by 2. You take the average rate and convert that cost of acquisition into a foreign currency. Point number 5, very important, indexation will not be allowed. Once you have converted everything to foreign currency, you calculate the capital gain without taking the benefit of indexation. Dixit says, sir, why indexation is not allowed? Dixit, these foreign people do not know that Indians are allowing indexation. So government took the advantage of this. These foreign people do not know. At that point of time, they might not be knowing that government is allowing indexation benefit. So government took away their indexation benefit. On one hand, they created an option for them to calculate the capital gain in foreign currency. On the other hand, they took away the indexation benefit. So indexation will not be allowed. Definitely this step was taken in the favor of government. So indexation will not be allowed. You now calculate the capital gain in foreign currency. You have converted your full value of consideration, expense on transfer, cost acquisition, everything into foreign currency. Now you calculate capital gain in foreign currency. You will derive the amount of gain loss in a foreign currency. So calculate capital gain in foreign currency. Now you have the amount of either capital gain or capital loss, and that you have it in foreign currency. Now you reconvert this capital gain. You reconvert this capital gain into Indian currency by taking buying rate on the date of transfer. Of the date of transfer, you take which rate? Buying rate. Because that foreigner on the date of transfer is going to buy the foreign currency, na? So you take the buying rate. So this is the approach which is required to be followed for calculation of capital gain in case the non-resident or foreign company has come to India taking the foreign currency and they have invested money in the shares or debentures of a Indian company. Important point to be noted. This section 48 proviso 1 is mandatory in nature. Now non-resident foreign company cannot say, no, I want to calculate my capital gain in Indian currency only. No, that is not allowed. That is not allowed. Now it is mandatory. You came with your grievance to us. We have given you the solution for the grievance. So now you can't say, no, I don't want this solution because Indian currency, if I calculate, that situation is more beneficial to me. No, you can't do that. You came to us with grievance. We have resolved your grievance. You were satisfied with the resolution of the grievance. Now that resolution is mandatorily applicable. You have to accept throughout your life. So section 48 first proviso is mandatory in nature. It is applicable in case of listed as well as unlisted shares or debentures. It is just that shares or debentures should be of Indian company. That's all. It can be listed, it can be unlisted, it can be anything. Section 48 proviso 1 is not applicable in case of bonds of central government, bonds of state government and RBI. It is also not applicable in case of units. See where it is not applicable, you just remember it is applicable in case you are investing money in the shares or debentures of Indian company. That's all. Okay, let's move on to the last point. Now this section 112 yesterday we discussed, na? Refer to this point. If SSE wants to take the benefit of concessional rate of tax, see his capital gain would be taxable at what rate? His capital gain on this would be taxable at 20%. But if SSE wants to take the benefit of 10% as per section 112A, then benefit of section 48 first proviso will not be available. Means if SSE says that I am ready to pay 10% tax as per section 112A, which you have offered to other Indians also, please consider me also as Indian, let me pay 10% tax. In that case, we will ask him to calculate capital gain in Indian rupees. We will not allow him to calculate capital gain in foreign currency. Have you understood this provision? Yes or no? Okay. Now I move on to point number 2. In case of any other asset means other than shares and debentures of Indian company acquired by a non-resident. In that case, this provision is not applicable. This provision is applicable only when he is acquiring shares and debentures of Indian company, that's all. In case of any other asset, it is not applicable. If he comes to India, he purchases a plot of land and thereafter he sells the plot of land, then he has to calculate capital gain in Indian rupees only. Section 48 proviso 1 benefit is not available. In case of any other capital asset other than shares and debentures of Indian company acquired by a non-resident including foreign company, the procedure explained in point number 2 above shall not be applicable and the capital gain shall be computed in the normal manner, the way it would have been calculated otherwise for a resident SSE. In other words, capital gain or loss shall be computed in Indian currency only. The benefit of indexation will also be available. Have you understood this very clearly? Yes? Now we have question number 23 on this. I have one question number 23. Let's refer to that question and try to solve. See this. It is on page number 216 of your textbook. Page number 216. Dikshit says first point is mandatory, third point is giving benefit. One second. Huh? Dikshit, the third point, section 112A, is introduced very recently in 2018 only. That is what I explained you yesterday, na? Whereas this foreign currency section 48 proviso 1 was inserted long back. I think more than 30 years back. Not more than 30, more than 35. So while making section 112A, government has not clarified na, applicable to him, applicable to whom. So it is applicable to everyone. This is just an interpretation. Section 112A do not clearly specify that it is applicable to whom. So if it doesn't specify, by default it is applicable in all situations. Let's move on to this question number 23. A non-resident purchases shares of Reliance Industries Limited on 1st January 2016 by remitting US dollars. The following data is given. Cost to acquisition is 5,85,000. Cost to acquisition is 5,85,000. This is rupees. Date of sale. Date of acquisition is 1/1/2016. Date of sale is 1st January 21. Sale price is 9 lakhs. Date of transfer is 28th December 2020. Expense on transfer is 6,600. So all these things is in Indian rupees. On 24th April 2021, 6,15,000 was invested in the shares of Tata Limited out of the sale proceeds of 9 lakh. So, first of all, he has acquired shares of Reliance. After selling the shares of Reliance, he has acquired shares of Tata Limited. See, this section 48 proviso 1 is not only applicable for the first investment, it is also applicable for reinvestment. Once you brought the foreign currency into India, you invested money in the shares of one company. Thereafter, you sold off and you invested money in the shares of another company. In that case also, you invested money in the shares of Tata by bringing foreign currency. That is what we say. So it is applicable to initial investment as well as subsequent investment. So he invested money in the shares of Tata out of the sale proceeds of 9 lakh. This was sold on 31st December 21 for 10 lakh 50. This was sold for 10 lakh 50 on 31st December 21. Exchange rates of different dates are given to you. So let us discuss the solution. You can keep page number 216 in front of you. And solution is already given to you in printed form. So we'll just quickly refer to the solution. I don't have that much time that I should give you time to solve this question on your own. That much time we are not left with. So we move on to page number 235. Answer 3. Tell me on which date he has sold the shares of Reliance? 1st January 21. That falls into which year? Previous year, 2021. That is assessment year 21-22. So there is long-term capital gain on transfer of shares of Reliance Industries Limited. These shares were acquired on 1st January 2016 and these are sold on, they are sold on 1st January 21. But period of holding you have to take 1 day prior to that date. So I have taken 31st December 20. And if you want, you can write previous year right now. In this example is 2021. What is the sale price? 9 lakhs. This sale price you have to convert it into dollars by taking which rate? Average rate of the date of transfer. What is the date of transfer date? Yes, 1st January 21. Do you have the exchange rate of 1st January 21? Yes. Telegraphic transfer buying rate is 39. Telegraphic transfer selling rate is 41. So 39 is buying rate, 41 is selling rate. You take the average, 39 plus 41 divided by 2. So your average is 40 rupees per dollar. So 9 lakh divided by 40 will give you 22,500. Check that if you want. 9 lakh divided by 40. Are you getting 22,500? Very good. Now let's take the expense on transfer. Expense on transfer is given as 6,600 rupees. This also you have to take average rate of the date of transfer. Average rate of date of transfer is 39.41 divided by 2. That is 40 rupees. So 6,600 divided by 40 will give you $165. $165. Then you take the cost of acquisition. Cost of acquisition is 5,85,000. 5,85,000. That you convert it into dollars by taking the average rate of date of acquisition. What is date of acquisition? 1st January 16. Take the average rate 38 plus 40 divided by 2. Average rate is 39. So 5,85,000 divided by 39. How much amount you will get? 585 divided by 39 is how much? Yes? Give me the numbers fast. 585 divided by 39, are you getting $15,000? Yes. So now let's calculate the long-term capital gain. $22,500. $22,500 minus 15,000 minus 165. So you get $7,335. $7,335. This $7,335, you should convert it into Indian rupees by taking the telegraphic transfer buying rate on the date of transfer. Date of transfer is 1st January 21. Telegraphic transfer buying rate is 39 rupees per dollar. So $7,335 multiplied by 39 rupees. So you are getting the amount of 2,86,065. Yes, have you understood this very clearly? Let us proceed further. Now we have also acquired the shares of Tata Limited on 24th January 21. Sorry, 24th April 21. 24th April 21 falls in which year? Previous year 21-22. So it is previous year 21-22. And he has sold this shares on which date? 31st December 21. So the period of holding is less than 12 months. So this time it is not long-term gain, it is short-term gain. So I am writing here previous year 21-22, assessment year 22-23, short-term capital gain on transfer of shares of Tata. Period of holding is from 24th April 21 to 30th December 21. There the date of transfer is 31st December 21. I need to take 1 day prior to that. So it is 30th December 21. Can you tell me what is the sale price? 10 lakh 50. Let us convert this into US dollars by taking the average rate on the date of transfer. Date of transfer is 31 December 21. What is the rate? 41.43. You take the average of 41.43. Yes. 42. 10 lakh 50 divided by 42 will be how much? $25,000. Are you getting it? Yes. Okay. Let's now take the cost acquisition. What is the cost acquisition? 6 lakh 15. You don't have any expense on transfer here. So this 6 lakh 15 is the cost acquisition in rupees. And the date of acquisition is 24th April 21. 24th April 21. Let us try to convert this cost acquisition into dollars by taking the average rate 42. So average rate will be 41. 6 lakh 15 divided by 41 is $15,000. So your short term gain is 25,000 minus 15,000, that is $10,000. Now let's convert this $10,000 by taking the telegraphic transfer buying rate. Let's convert this by taking the telegraphic transfer buying rate of the date of transfer. Your date of transfer is what? 31st December 21. 31st December 21, what is the buying rate? 41 rupees per dollar. So 10,000 into 41, that is $410,000. Yes, have you understood this very clearly? So please mark this as very, very important, because this is the first time CA Institute has inserted this section 48 proviso 1 in CA intermediate syllabus. Last year May 20 module was not there. So there are brighter chances that they would ask a question on this in the examination. If they ask, you should not be taken by surprise. So please revise this day before examination. So we have covered everything. Our tax rate discussion is also over. Now I think we need to just discuss question number 19, right? Section 55, yes. Yes, Dikshit, I'll cover section 55 also. Plus I need to cover up question number 19. You move on to question number 19. It was given to you as homework, na? Look at this, page number 215. Page number 215. 1st March 21. X sells the following assets. Self-generated goodwill of business long term. Yes, in case of self-generated goodwill of business, what will be taken as your cost acquisition? In case of self-generated goodwill of business, what will be taken as your cost acquisition and cost of improvement? Do you recollect? So cost of acquisition, cost of improvement, both will be taken as 0. So can I say this entire amount is long-term gain? Next, bonus shares in A Limited, listed. This is long-term capital asset. These are sold off market. Definitely this is long-term gain. But in case of long-term gain, we have two sections to apply. Section 112, section 112A. So you have to identify which section is applicable because the tax rate is different. So this 14 lakh is covered by section 112. The 6 lakh gain. See, the 6 lakh is sale consideration. But in case of bonus also your cost of acquisition is 0. So capital gain will be 6 lakhs only. You know that if you are having equity shares or units of equity oriented mutual fund or units of business trust, sale transaction is done through stock exchange, securities transaction tax is paid. In that case, your long-term capital gain will be covered by section 112A. But here, the transaction is happened off market. Off market means sale transaction is not done through stock exchange. Means securities transaction tax would not have been paid. So in this case, this is covered by section 112 and not 112A. Correct? Huh? Tax rate will be 20%. Yes, and these are listed. Since these are listed, you have an option 20% with indexation or 10% without indexation. Which option you would go for? Definitely 10% without indexation. Why? Because your cost is 0. Your cost is 0. On what you will apply the indexation? So you will go for 10% without indexation. Have you understood this? Yes or no? So here the tax rate is 20%. Here 10% without indexation. You have an option in case of listed securities, 20% with indexation or 10% without indexation, whichever is beneficial to the SSE. So here we cannot go for 20% with indexation because it is a bonus shares, your cost of acquisition is anyway 0. So there is no point in applying any indexation. So we would go for the second option, that is 10% without indexation. Next you have bonus shares of B Limited. These are non-listed. Since these are non-listed, you don't have the option of 20% with indexation, 10% without indexation, whichever is beneficial to SSE. That option is not available. That option is available only in case of listed. It is not available in case of unlisted. This is a short-term asset. This is sold off market. If this would have been sold on market, STD would have been paid. In that case, it would have been covered by section 111A. Tax rate would have been 15%. But right now, it is not covered by section 111A. So this gain would be taxable at normal rates. Normal rates. And here it is a bonus shares, na? So cost acquisition is anyway 0. This 8 lakh is the sale consideration, but the cost acquisition is 0. So this is short-term capital gain taxable at normal rates. Next, listed debentures of C Limited. Yesterday I told you very important point. In case of debentures and bonds, you are not going to get the benefit of indexation. In case of bonds and debentures, you don't get the benefit of indexation. But yes, if the bonds are issued by central government and they are capital index bonds, or bonds are issued by RBI, they are sovereign gold bonds. In those cases, you can take the benefit of indexation. Besides that, you can't take the benefit of indexation for bonds and debentures because for time value of money, you have already got the interest. So listed debentures of C Limited sold for 1 lakh. They were acquired in 2004 for 40,000. So can you tell me it is long-term asset or short-term asset? Listed debentures fall into which category? Category 1. Period of holding applicable is 12 months. Here the period of holding is more than 12 months. So definitely it is a long-term asset. You have to calculate long-term gain, but you won't get any indexation because in case of bonds and debentures, indexation is not allowed. Yes, is that very, very clear? Now let us calculate the capital gain. 1 lakh is the sale consideration. 40,000 is my cost acquisition. So my capital gain will be how much? It will be 60,000. This 60,000 is long-term gain. This 60,000 is long-term gain. Tell me, this would be taxable at what rate? It is listed. It is listed. This will be covered by section 112. 20% with indexation, 10% without indexation. But you know that in case of bonds and debentures, indexation benefit is anyway not available. Therefore, definitely you will go for 10% without indexation only. Is that very clear? Find out the tax liability of Mr. X for the assessment at 21-22 on the assumption that the business income is 6,000. This business income will also be taxable at normal rate. This business income will also be taxable at normal rates. So let us quickly move on to the solution. Tell me, what is the business income? See, everything is calculated, capital gain is calculated. Self-generated goodwill of business, 14 lakh is long-term gain. Bonus shares of A Limited, 6 lakhs is long-term gain. Bonus shares of B Limited, 8 lakhs, this is short-term gain. And listed debentures, long-term gain 60,000. Now give me what is the business income? 6,000. It is given in the question. Get me the amount of long-term gain. 14 lakhs plus 6 lakhs is 20 lakhs plus 60,000. That is 20 lakhs 60,000. Then we have short-term gain 8 lakhs. So capital gain total is 28 lakhs 60,000. Your net taxable income is how much? 28 lakhs 66,000. Correct? Now we need to calculate the tax liability. Let us calculate tax liability first. On income other than long-term gain. Basically, we will try to calculate the tax liability on those income which are taxable at normal rates. Which incomes are taxable at normal rates? Yes. Point number 3. Short-term gain on transfer of bonus shares of B Limited. That is taxable at normal rates, 8 lakhs. Business income, 6,000. That is also taxable at normal rates. So, tax on what? Tax on 8 lakh 6,000. Tax on 8 lakh 6,000. Give me the amount of tax on 8 lakh 6,000. Nothing is mentioned. So, Mr. X is an individual. Age is less than or equal to 60. Basic exemption limit is 2 lakh 50. Up to 5 lakh. His tax liability will be 12,500. Above 5 lakh. Income is 8 lakh 6. So, 8 lakh 6 minus 5 lakh is 3 lakh 6. 3 lakh 6,000 into 20%. 3 lakh 6,000 into 20% plus 12,500 would be 73,700. Very good. Don't add cess. 73,700. This is excluding cess, right? Now, to this, point 1 was tax on income other than LTCG. Now, point 2 is tax on LTCG. Point 2 is tax on LTCG. Tax on the goodwill is how much? 14 lakh into 20%. 2 lakh 80. Then 6 lakhs. Capital gain on sale of bonus shares in L Limited 6 lakhs. That will be taxed at 10% without indexation. That is 60,000. Then we have listed debentures. 1 lakh minus 40. That is 60,000. Of that, 10%, that is 6,000. So our total tax on long-term gain will be how much? 28 lakhs 66,000. Now give me the total amount. Oh, 2 lakh 80 plus 60 is 340 plus 6 is 346. By mistake, I took the amount of income. 346 plus 73 700 is 4 lakh 19,700. Now we had a 4% cess. Get me the amount of 4% cess. 4% of 4 lakh 9,700 is 16,788. Get me the tax liability. 436 488. 436 488. Round off this amount. 436 490. 436 490. Yes, is that very clear? Now let's move on to section 55A. Section 55A, page number 197. This was given to us homework. Now listen to me very carefully. See, there are a lot of instances in the chapter of capital gain where you consider fair market value to be full value of consideration. Besides, there are a lot of instances under the chapter capital gain where you consider fair market value as your cost of acquisition also. So sometimes the fair market value is considered as full value of consideration. Sometimes the fair market value is considered as cost of acquisition. Yes, there are a lot of instances. I don't want to now get into the details. I have already given you the list also, if you recollect. On that same page. On that same page above that, see, all these situations are covered here. Barter exchange, conversion of capital asset into stock in trade, transfer of asset by partnership firm to partner. This liquidation part will be covering in the chapter of other sources. Shares received in ESOPs, consideration is not ascertainable, section 50D. So these are the instances wherein you consider fair market value to be FOC. And you also know that if you acquire the capital asset prior to 1st April 2001, if you acquire the capital asset prior to 1st April 2001, then you have an option of considering your actual cost of acquisition or fair market value on 1st of 2001 to be your cost of acquisition for computing capital gain. So here you consider the FMV to be your cost of acquisition. What will happen is, whenever your fair market value is considered as full value of consideration, SSC would try to show the fair market value to be lower. SSC would try to show the fair market value to be lower. If he shows fair market value to be lower, his capital gain will be lower. So SSC may try to manipulate the fair market value. He may go to the valuer and he may offer some bribe to the valuer. Valuer will give report valuer will give the report with respect to the fair market value, mentioning the lower amount. In that case, SSC's full value of consideration will be less, capital gain will be less. On the other hand, whenever the fair market value is taken to be cost of acquisition, what SSC would try to do? He will increase the fair market value. If he shows fair market value to be higher, then his cost of acquisition will be higher. If cost of acquisition is higher, then definitely capital gain will be lower. So ultimately SSC would try to manipulate the fair market value with the intention to reduce his capital gain. Ultimately, SSC would try to reduce the fair market value or increase the fair market value with the intention of reducing the capital gain. Here in first instance he is reducing the fair market value. In second instance, he is increasing the fair market value. But in both instances, the capital gain is getting reduced. So someone should monitor this. Someone should have a watch on this. It is not possible to appoint officers who can check check this. So government has given right to the income tax officer. Government has given right to the income tax officer. Whenever income tax officer picks up any case in scrutiny and he feels that the fair market value declared by the SSC doesn't actually correspond to the fair market value which is prevailing in practical life, in that case, officer has a right to refer the case to the valuation officer. Officer will transfer this case to the valuation officer which is working in the income tax department only. That valuation officer will then give the valuation report. That valuation report will have the correct fair market value. And based on that fair market value, capital gain will be calculated. So income tax officer has the right to send your case to the valuation officer. This right is given to the income tax officer in section 55A. So section 55 is reference to valuation officer. Reference to valuation officer. See what it says. With a view to ascertain the fair market value of the capital asset for the purpose of this chapter, assessing officer may refer the valuation of the capital asset to the valuation officer in following three circumstances. So in these three circumstances, assessing officer has a right to send your case to the valuation officer if he feels that your fair market value is not correct. Point A, value of asset claimed by the SSC in accordance with the estimate made by the registered valuer. And see, when you consider the fair market value to be full value of consideration, you are claiming that this is the value of the asset. When you are considering fair market value to be your full value of consideration, you are claiming that this itself is the value of asset, and that value is decided by the registered valuer. But assessing officer is of the opinion that value so claimed by the SSC is at variance with the actual fair market value. So that value which is claimed by the SSC and that is ascertained by the registered valuer, that value is at variance with the actual fair market value. In that case, assessing officer will send your case to the departmental valuation officer. That valuation officer is working for the income tax department. Point number B, if assessing officer is of the opinion that fair market value is more than the prescribed limit. If assessing officer is of the opinion that fair market value is more than the prescribed limit. In any other case means other than point A, where value claimed by assessee is not based on the report of registered valuer. Here in point number B, value, fair market value which is claimed by the assessee is not in accordance with the report given by the registered valuer, but assessing officer is of the opinion that fair market value exceeds value of asset claimed by the assessee by these amounts. Say for example, I will take an example to make you understand. First amount is more than 15% of value of asset as claimed by the assessee, and second amount is more than 25,000 as the case may be. For example, this is value of asset claimed by assessee. Assessee claims that the value of asset is 1 lakh rupees. Assessee claims that the value of asset is 1 lakh. Now read this, what it says. In any other case, if assessing officer is of the opinion that the fair market value is more than the value of asset as claimed by the assessee by more than 15% of the value of asset claimed, means actual fair market value as per assessing officer is more than 15% of the value of asset claimed by the assessee. 1 lakh is the value of asset claimed by the assessee, 15% of that is 15,000. So if in the opinion of the assessing officer, your actual fair market value is more than 1,15,000. More than 1,15,000, or second amount, they have given 25,000. They have given 25,000. So say for example, value of asset claimed by the assessee is 1 lakh. Actual fair market value is 1,50,000. So can I say the difference is 50,000? Difference is 50,000. That is exceeding 25. Yes. Is that exceeding 15% of the value of asset claimed by the assessee? Yes. In that case, he will send your case to the departmental valuation officer, and departmental valuation officer will ascertain the value of the asset. Third point, assessing officer is of the opinion that it is necessary to make a reference in the interest of the revenue based on the nature of asset and other relevant circumstances. Nature of asset is such that fair market value is not easily available. For example, Dikshit is having sword of Tipu Sultan. The Tipu Sultan sword is an archaeological collection, and Dikshit is having that sword. So he is selling that sword. Now for example, this is covered by, this sword is given by partnership firm to the partner. In that case, fair market value is considered as full value of consideration. But it is very difficult to get the fair market value for such an asset, because the nature of asset is such that you don't have any other asset available like this. In that case, officer can send your case to the departmental valuation officer. So in these three circumstances, your assessing officer is having a right to send your case to the departmental valuation officer. Departmental valuation officer will then find out the correct fair market value and he will submit the report to the income tax officer. And accordingly, income tax officer will then calculate the capital gain. Is that very, very clear? Yes or no? Now, everything is over properly? See page number 179. For a minute, move on to page number 179. Before that, you can move on to page 176. 176. See page number 176. We have section 2 clause 42A explanation. Period of holding in different circumstances. How to get the period of holding in different circumstances. In liquidation of company, how to take the period of holding. At the time of liquidation, shareholder will transfer his shares to the company now. What he should take the period of holding. Shares of amalgamated company, they are received by the shareholder in exchange of shares of amalgamating company. What he should take as period of holding. Issue of shares of resulting company in exchange of shares of demerged company. What should be taken as period of holding. Bonus shares, conversion of debentures, conversion of preference shares into equity shares, conversion of stock in trade into capital asset, right shares, renouncement of right entitlement, section 49(1), special transaction with respect to gift, will, inheritance, succession, etc. Sweat equity shares. See this page na, period of holding, these all circumstances, I have not covered separately, I have covered with the respective topics. I have covered with the respective topics. Do you recollect? Yes or no? See, now I am having two sections. Section 47, section 49(1). Section 47, two clauses I have discussed with you. 40 and 1 also I have discussed with you few points. Remaining points I told you to refer. See this section 47. If you have not referred, you can refer this as part of homework. Section 47. Page number 179. And section 49(1). Page number 180, 181 and half page of 182. So kindly refer this section 47 and section 49 subsection 1 as part of homework. We will discuss if you have the doubts. Listen to me carefully. Section 47 is the list of transactions which are not considered as transfer. So all those transactions which are mentioned in section 47, in that case, there won't be any capital gain in the hands of transferor. For example, I have already told you that when the capital asset is transferred to someone by way of gift, will, inheritance, succession, devolution or on partition of HF, there won't be any capital gain. Similarly, if there is a amalgamation between two companies, then amalgamating company will transfer the asset to amalgamated company. There won't be any capital gain in the hands of amalgamating company. The shareholder of amalgamating company will return the shares of amalgamating company. In exchange, he would receive the shares of amalgamated company. There won't be any capital gain. So, there is a list of transaction which is not considered as transfer. That list is given in section 47. You refer to that list. And then we have section 49 subsection 1. Section 49 subsection 1 gives you the details of cost of acquisition. In different situations, what should be considered as cost of acquisition, that we have already discussed. But still you refer to section 49 subsection 1. If you recollect, I have already told you that if any capital asset is acquired by way of gift, will, inheritance, succession, devolution, or on partition of HUF, then the cost of acquisition of previous owner will be considered as cost of acquisition of SSE. Cost of acquisition of previous owner will be considered as cost of acquisition of SSE. And what do you mean by previous owner? Previous owner means last such owner who actually acquired the asset by paying money for it. This is already discussed with you in different parts of the chapter. You can still refer to this. You can refer to this. If at all you have some doubts in section 47, section 40 and 1, we'll definitely cover. Don't worry about that. So, these things are over. Section 47, section 40 and subsection 1 I have given you as homework. Now tell me that amalgamation, demerger, have you referred? Page number 201. This amalgamation, no one is going to ask you a question on this, but still have you referred? Do you have any doubt? Do you want me to discuss this? Actually, up to last year, my last year textbook, I did not insert this. This time I have inserted. Yes? Tell me, do you want to discuss? Shall I discuss slightly? Yes, okay, not an issue. So, I will discuss, don't worry. Now listen to me carefully. My target is to wind up this chapter in next 15-20 minutes. Next 15-20 minutes, we will wind up this chapter and then we'll move on to income from other sources. Amalgamation. Let me take an example. See, what do you mean by amalgamation? In income tax, there is a definition of amalgamation. There is a definition of amalgamation. Only if these conditions are fulfilled, this would be called as amalgamation. It may happen that you may consider that as amalgamation as per accounts, but as per income tax, it is not an amalgamation, because the conditions given here are not fulfilled. So what do you mean by amalgamation? Amalgamation means merger of one or more companies with another company. Merger of one or more company with another company, or merger of two companies to make one company. Merger of two or more companies to form one company. Have you completed the chapter of amalgamation in accountancy? In accounts, have you completed chapter of amalgamation? Yes. So in accounts, you might have learned something called as amalgamation absorption also. Amalgamation absorption also, no? See, in income tax, there is nothing called as absorption. That absorption is also called as amalgamation only. A Limited taking over the business of B Limited, you call it as absorption in accounts. But here we are in income tax. So when A Limited takes over the business of B Limited, it is not called as absorption here. Here we call it as amalgamation. A Limited taking over the business of B Limited, or A Limited, B Limited both are closing down and they are forming a new company, AB Limited, that will also be called as amalgamation. So whatever you understand it as amalgamation in accounts, whatever you understand it as absorption in accounts, both are considered as amalgamation only. In income tax, both are considered as amalgamation. Now point number 1 says, all the assets and liabilities should be transferred. means when all the assets and liabilities of amalgamating company are transferred to amalgamated, then only it will be considered as amalgamation. If few assets are sold, if few assets of amalgamating company are sold, then in that case we don't consider that to be amalgamation. Benefit of exemption will not be given. Number 2 condition, shareholder holding minimum 75% in value of shares in the amalgamating company, they become the shareholders of amalgamated company. So minimum 75% shareholders, 75% not in number of shareholders, 75% in value terms. I may have 80% shares of one company. So I become the shareholder of amalgamated company. This condition is fulfilled. Now further, so I have explained you what is this definition of amalgamation. Now let me take an example. There is company A Limited. There is another company B Limited. These both companies are closing down and they have amalgamated and formed a new company AB Limited. So don't you feel A Limited will transfer all its assets? A Limited will transfer all its assets to the AB Limited. B Limited will also transfer all its assets to AB Limited. In that case, who is transferor? A Limited and B Limited are transferor. AB Limited is transferee. A Limited and B Limited are transferor. AB Limited is transferee. Here we are saying that there won't be any capital gain in the hands of amalgamating company when they are transferring asset to amalgamated company. There won't be any capital gain in the hands of amalgamating company when they are transferring assets to amalgamated company. Have you understood this? Yes or no? Look at this. Section 47 clause 6. 47 clause 6. Transfer of capacity by amalgamating company to the amalgamated company in the scheme of amalgamation is not considered as transfer, provided condition is the amalgamated company should be Indian company. In other words, there is only one condition. This AB Limited now, it should be an Indian company. This AB Limited should be Indian company. Next, now the assets are in the hands of amalgamated company. The assets are transferred by amalgamating to the amalgamated. Now the assets are in the hands of amalgamated company. In future, this amalgamated company might sell the assets. In future, this amalgamated company might sell the assets. So at that point of time, what should be taken as period of holding? Period of holding of amalgamating company should be added to the period of holding of amalgamated company. What should be taken as cost of acquisition? As per section 40 and subsection 1, cost of acquisition of amalgamating company will be taken as cost of acquisition of amalgamated company. If the capital asset was acquired prior to 1st April 2001, then you also have the option of considering fair market value on 1st April 2001 as your cost of acquisition for computing capital gain. Now let us move on to discuss what will be the taxability in the hands of shareholder. What will be the taxability in the hands of shareholder? Now by explaining you this point, I am taking the example of only A Limited. I am taking the example of only A Limited. Same thing will also be applicable to B Limited also. A Limited and AB Limited. Now see what will happen in case of amalgamation. A Limited will transfer the business. When we say A Limited will transfer the business to AB Limited, they are transferring assets and liabilities. In exchange of this, AB Limited will issue shares. shares. Yes. Now say for example we have shareholder of A Limited. We have shareholder of A Limited. What he will do, since A Limited is closing down now, he will transfer the shares of A Limited. He will transfer the shares of A Limited. In exchange, he would receive what? He would receive shares of AB Limited. Yes or no? The shareholder of amalgamating company will return the shares of amalgamating company to the amalgamated company. In exchange of that, he is going to receive the shares of amalgamated company. What would be the treatment in the hands of shareholder? That is expenditure, taxability in the hands of shareholder. Here we say that when the shareholder of amalgamating company is transferring the shares of amalgamating company to the amalgamated company, this would not be considered as transfer. This would not be considered as transfer. So no capital gain in the hands of shareholder, provided the company is Indian company and he is receiving consideration only by allotment of shares. He is receiving the consideration only by allotment of shares. So, shareholder of amalgamating company is returning shares of amalgamating company to the amalgamating company and he is receiving the shares of amalgamated company in exchange. This will not be considered as transfer. Capital gain will not be calculated provided two conditions are fulfilled. First condition is the amalgamated company should be Indian company, and second condition is the consideration which the shareholder has received is only one thing, that is shares of amalgamated company. Now tell me, now shareholder is having what? Shareholder is having what? Shareholder is having shares of amalgamated company. In future what he will sell? He will sell the shares of amalgamated company. At that point of time, what should be taken as period of holding? Period of holding for the shares of amalgamated company should include the period of holding for the shares of amalgamating company. Sarvana is asking questions, sir. A Limited share value in market price is 500, AB Limited is 1500%. In this case, non-taxability of, see Sarvana, listen to me. If the shareholder is returning one share of amalgamating company, then he is not going to receive one share of amalgamated. That exchange ratio will be decided by the company na, based on the market value of shares only. Say for example, you have given me the information saying that the market price of the shares of amalgamating company is 500 rupees and the market price of shares of amalgamated company is 1500 rupees. So in that case, they would decide the ratio 1:3. Amalgamating company 1, amalgamated company, 3:1 means if you are having 3 shares of amalgamating company, you will get 1 share of amalgamated company. That is the manner in which that ratio will be decided now. Sarvana, are you understanding? Yes or no? Okay. Now, when the shareholder will sell the shares of amalgamated company, at that point of time, you have to take the combined period of holding. Period of holding for which the shares of amalgamating company were held, plus the period of holding for which the shares of amalgamated company were held, combined. What should be the cost of acquisition of shares of amalgamated company? That should be nothing but the cost of acquisition of shares of amalgamating company. So for the shareholder, cost of acquisition of shares of amalgamated company is nothing but the cost of acquisition of shares of amalgamating company. This we have completed. Yes. Let's move on to demerger now. Last part, demerger. I am giving an example. Please understand this. There is a company, Reliance Industries Limited. They are into three businesses: oil and gas, retail, and telecom. Telecom business they have transferred to new company. They have formed a new company. Reliance Geo Communication Limited. So this Reliance Industries Limited will be called as demerged company. Reliance Geo Communication Limited will be called as resulting company. Now in case of demerger, please understand that in case of demerger, both companies would exist. After the demerger, Reliance Industries Limited will have two undertakings: oil and gas business and retail. Reliance Geo Communication will have only telecom business. Now say for example, there is a shareholder of Reliance Industries Limited. Now first of all, let us understand that Reliance Industries Limited had, say for example, entire company's net worth, including oil and gas, retail and telecom business, is at 10,000 crores. Reliance Industries Limited, their net worth is 10,000 crores. The net worth is 10,000 crores. Out of 10,000 crores now, assets and liabilities will be transferred to Reliance Jio. Assets and liabilities is transferred. Basically net worth, net assets of say 2,000 crores. Out of 10,000 crores, assets and liabilities, net assets worth 2,000 crores are transferred to Reliance Jio. Now what will happen now? So 20% assets are transferred. 20% net assets are transferred. Now the shareholder of Reliance Industries Limited will be asked to give back few shares of Reliance Industries, and in exchange he would receive few shares of Reliance Jio. Shareholder will return few shares. Say for example, shareholder is holding 1,000 shares. Out of 1000 shares, he is asked to give back 20% shares. So he is giving 200 shares. Of which company? Reliance Industries Limited. Since Reliance Industries Limited is transferring shares to Reliance Jio would issue the shares. These shares of Reliance Industries Limited will give to the shareholders. Shares of Reliance Jio Communication Limited. Have you understood this entire process? Not at all complicated, very simple it is. Now let us move on to the provisions. See, here we have the definition of demerger. Definition of demerger: all the assets and liabilities of the Reliance Industries Limited Telecom division should be transferred to the demerged entity. What do you mean by assets? What do you mean by liabilities? This definition is given here. I don't want to explain you this. This we generally cover at CA final. This won't be there in your module also. Point 2, all assets and liabilities should be transferred at book value. So whatever assets and liabilities demerged company is transferring to resulting company should be transferred at book value. Revaluation should be ignored. Revaluation should be ignored. Point 3, resulting company issues shares to the shareholders of demerged company. Resulting company will give the shares to the demerged company, and demerged company will give those shares to the shareholders of the demerged company. Shareholder holding minimum 75% in value of the shares of demerged company should become the shareholders of resulting company. So 3/4 majority should be there in value terms. The transfer is on a going concern basis. What do you mean by transfer is on a going concern basis? Means business is not closed down. Telecom business is not closed down. It is transferred on a going concern basis by the demerged company to the resulting company. Now, these are the conditions for demerger. If all those conditions are fulfilled, it will be considered as demerger as per section 2 clause 19AA. I don't think that this definition would have been given in your module also. Taxability in the hands of demerged company. Demerged company is transferring the assets and liabilities to resulting company. This will not be considered as transfer in the hands of demerged company. Demerged company would not be required to calculate capital gain, provided the resulting company, the company to whom the assets are transferred, is a Indian company. So Reliance Jio Communication Limited should be an Indian company. What would be the taxability in the hands of resulting company? Now the assets of telecom division are in the hands of resulting company Reliance Jio. What would be the cost of acquisition for them? As per section 49 subsection 1, cost of acquisition for resulting company would be nothing but the cost of acquisition of demerged company. Period of holding of asset should also include the period of holding for which the asset was held by the demerged company. What is the taxability in the hands of shareholder? At the time of demerger, shareholder is transferring few shares in the demerged company to the demerged company. In exchange, he is receiving the shares of resulting company. That would not be considered as transfer, so he is not required to calculate capital gain. As per section 2 clause 42A, whenever the shareholder sells the shares of resulting company while taking the period of holding, you should also include the period for which shares of demerged company were held. And last is section 49 subsection 2C, section 49 subsection 2D. That I will help you to understand with the same example. Now say for example, the shareholder of Reliance Industries, he is having how many shares? 1000 shares. Say for example, he had bought these 1000 shares at the rate of 900 rupees per share. 900 per share. So his investment would be worth how much? 9 lakhs. Correct? His investment would be worth 9 lakhs. Now what he has to do? 1000 shares na? On the occasion of demerger, 200 shares he has returned and he has received shares of Reliance Jio Communication Limited and he is having 800 shares of Reliance Industries Limited. These 200 shares of Reliance Industries Limited were transferred. Now the point is, he is having the shares of Reliance Jio. What should be taken as the cost of acquisition for the shares of Reliance Jio? $800 shares of Reliance Industries Limited. Yes? What should be taken as cost of acquisition? So tell me, what is the value of total investment? 9 lakhs. This 9 lakhs should be multiplied by net worth transferred to resulting company. That is 2000 crores. We are just taking the proportionate amount. What was the total assets liabilities of demerged company before demerger? 10,000 crores. So what would be the cost of acquisition of shares of resulting company? 1,80,000. Yes or no? And what would be the balance cost of the balance 800 shares of demerged company? 9 lakhs minus 1,80,000. That is 7,20,000. Have you understood this calculation? Yes or no? Yes. So this is it. This is the way in which cost will be calculated. So you can refer to 49(2)(c) and 49(2)(d), section 49 subsection 2c and section 49 subsection 2d on your own. This is the cost acquisition of shares of resulting company A into B by C, and then the cost acquisition of demerged company, old cost 9 lakh minus transfer to resulting company 180, balance is 720. Balance is 720. So this amalgamation demerger story is also over. So with this our capital gain chapter is totally completed. So what is left is I have given you section 47 and section 41 as homework. I think throughout my life this is the first time I have taken all these things in the class. Generally the amalgamation demerger they are not taught. First time I have inserted in the notes and first time I have taken it in the class at intermediate level. Final we take it in detail, we solve the practical questions also. So with this our chapter of capital gain comes to an end, and after the break we will move on to the chapter of income from other sources. So we will start income from other sources chapter. Income from other sources, very small chapter it is. Only 3-4 points are required to be discussed in detail. One is dividend income, the other one is gift provisions. Besides that, 2 small points, that's all. So income from other sources. This is the last and residuary head of income. Here we have 4 sections. Section 56, 57, 58, 59. Out of these 4 sections, first section, that is section 56, is the charging section. Section 57 is a section which will allow you deduction for the expense. Section 58 is a section which will disallow you the deduction for the expense. And section 59 is a section related to deemed income. It is a section related to deemed income. See, there is a lot of similarity between the chapter of PGBP and IFOS. PGBP versus IFOS, there is a lot of similarity. PGBP income is taxable based on mercantile system or cash system, whichever is regularly followed by SSE. Similarly, IFOS income is also taxable based on the mercantile system or cash system, whichever is regularly followed by SSE. In PGBP also we had certain exceptions saying that bad debts recovery will be taxable in the year of receipt. Similarly, here also we are having exceptions saying that dividend income will be taxable as per the taxability criteria given in section 8. And then we have interest on initial compensation and enhanced compensation, which we have already discussed while discussing compulsory acquisition in the chapter of capital gain. That interest is also taxable on receipt basis. But broadly we can say that income under the head PGBP as well as IFOS, both are taxable based on the method of accounting followed by SSE. This is the similarity. Second charging section under that PGBP is section 28. So 28 ones are 28, 28 twos are 56. 56 is the charging section of IFOS. Third, in the chapter of PGBP, for allowing deduction for the expense, we have sections from section 30 to section 38. Whereas in the chapter of IFOS, we have only one section for allowing deduction for the expense. And this too is copied. It is copied from section 30 plus section 31 plus section 32 plus section 37 subsection 1. So basically this section 57, the moment you read, you'll come to know that you already know these provisions. For disallowing deduction, in the chapter of PGBP, you had section 40 capital A subsection 2, excess payment to a specified person. You also had section 40 capital A subsection 3, amount exceeding 10,000 payment made by cash, etc. You had 40 clause A subclause 1, subclause 1A, subclause 2, 2A, 3, etc. Payments made without deducting TDS. Payments made without deducting TDS, excess payment to relative, payment exceeding 10,000 made in cash. So here in section 58, they have copied section 40 capital A subsection 2. They have copied section 40 capital A subsection 3. They have copied section 40 clause A subclause 1, subclause 1a. This they have copied here. So basically, I can say that section 57 and section 58 now, it's nothing but it is copied provisions from PGBP chapter. So definitely you might be knowing that. The last one is in the chapter of PGBP, if you recollect, we had discussed the section 41 subsection 1, deemed profit. That same thing is copied in the chapter of IFOS in section 59. So section 59 is copied from section 41 subsection 1. This is also copied from the chapter of PGBP. So you can say that you also know section 59. So this is the comparison of the PGBP chapter with the IFOS. Looking at this comparison, you definitely know that to a greater extent you know the chapter of IFOS also. So now friends, let us start with the actual chapter with the charging section. See, all these things I have already written here for you. Criteria of charging tax under the head income from other sources. Income under the head income from other sources is taxable based on the method of accounting followed by SSC. Either cash system or mercantile system, whichever is regularly employed by SSC. Whichever method is regularly followed by SSC, that method will be applicable for computation of income under income from other sources. Definitely to that we have exception. Dividend income will be taxable as per section 8. Interest on initial compensation, enhanced compensation will be taxable on receipt basis. That we'll discuss when we get into those sections. Section 56 is charging section. Section 57 is section for allowing deduction for expense. Section 58 is section for disallowing deduction for expense, and section 59 is deemed income. Now friends, let's move on to the charging section. Charging section, section 56 is divided in two parts. First is section 56 subsection 1 and the second one is section 56 subsection 2. Section 56 subsection 2 gives the list of incomes. Section 56 subsection 2 gives you the list of incomes which are specifically taxable under the IFOS. So section 56 subsection 2 is giving you the list of incomes which is specifically taxable under the head income from other sources. And this is an exhaustive list. This is an exhaustive list. Meaning thereby, every point you will have a different clause number. And it's a limited list of 11 to 12 points. Section 56 subsection 1. Section 56 subsection 1 doesn't give you any list. It has made some conditions. If those conditions are fulfilled, then your income can be taxed under the head IFOS. So section 56 subsection 1 gives you three conditions. So section 56 subsection 1 doesn't give you the list of income. It gives you three conditions. If all these three conditions are cumulatively fulfilled, then your income can be taxed under that income from other sources. The first condition is there should be an income. Second condition is such income should not be exempt. It should not be exempt. See, every receipt is not an income. That is what I explained you in the chapter of basic concept. You take a bank loan, it is a receipt, but it is not an income. So first of all, for charging tax under the IFOS, that receipt should be an income, number one. Number two, such income should not be covered by the list of exemption. In other words, it should not be exempt from tax. And number three, such income should not be covered under any preceding heads of income. If that income is already covered by income from salary, house, property, business, profession, capital gain, then it cannot be taxed under their IFOS. Otherwise, it would result into double taxation. To avoid double taxation, we are saying that such income should not be covered under four preceding heads of income. Now, friends, I will remind you certain points of different chapters wherein you told that income will not become taxable under that head, it will become taxable under IFOS. We have discussed a lot of such points in the chapter of salary also, in the chapter of IFSP also. Those points are already discussed with you. I'll just quickly go through it. See, section 56 subsection 1, left. Charging section 56 is divided in two parts, 56.1, 56.2. 56.2 is giving you the list of incomes which are specifically taxable under IFOS, and 56.1 is giving you the conditions. If these three conditions are fulfilled, your income can be taxed under income from other sources. Now the point is, which are those incomes which can be taxed under that income from other sources in section 56 subsection 1. So I have given you some illustrations. So this is the illustrative list. It is not an exhaustive list, it is an illustrative list. First point I have already discussed with you in the chapter of income from salary. If you remember, examinership fees received by the college faculty from the college is taxable under income from salary. But fees received by the college faculty from the university is taxable under income from other sources. On the other hand, university faculty receiving money from university is income from salaries, but the university faculty receiving money from college is income from other sources. This I have already discussed in the chapter of income from salaries. Point number 2 is also discussed in the chapter of income from salaries. I am just reminding you that this we had discussed. Point number 2, we said that salary received by MP/MLA is not taxable under income from salary because there is no employer-employee relationship between MP/MLA and the state government, central government. So, remuneration received by MP/MLA from the governments would be taxable under income from other sources, but daily allowance, constituency allowance received by them is totally exempt from tax in section 10 clause 17. So, income of MP/MLA, remuneration, it is taxable under income from other sources. Daily constituency allowance, it is exempt in section 10 clause 17. Point 3 was also covered in the chapter of income from salaries. Remuneration received by a full-time director is taxable under income from salaries because he is an employee of the company, whereas remuneration received by part-time director is not taxable under income from salaries, it is taxable under income from other sources because part-time director is not a employee, he is not an employee of the company. Point number 4 was not covered anywhere. So let me explain you point number 4. See, in a company there is a director. That director can be either full-time or part-time. Any director, for example, let us take the example of a part-time director. That director has acted as a guarantor for getting the loan for the company. Company wanted loan from the bank. Bank has asked for the guarantor, and director has acted as a guarantor for the company on payment of remuneration. On payment of some amount of money to the director, director agreed to act as a guarantor for the loan which is taken by the company from the bank. For that, director would receive guarantee fees. He would receive guarantee fees. One more point is, say for example, company is coming out with an IPO. So you know that at the time of IPO, you need to underwrite the shares. You need to do the underwriting of shares, because in case of under subscription, someone should be there to cover the risk of the company. So director has acted as an underwriter, and for that you have paid underwriting commission to the director. This will be taxable to the director under the head income from other sources. So director's commission for what? For standing as a guarantor to the bank, for the loan taken by the company from the bank, or director's commission for underwriting the shares of a company. This would be taxable to director under income from other sources. Point number 5 is already discussed in the chapter of income from salaries. If you remember, at the time of retirement, if employee has withdrawn money from unrecognized provident fund, that amount received from the unrecognized provident fund at the time of retirement is broken down into 4 parts. Employee's contribution is not taxable because it is already taxed. Why it is already taxed? Because you levy tax on gross basic salary and not net basic salary. An employee would contribute money to the fund out of the gross basic salary only. Employer's contribution is taxable under income from salaries. Interest on employer contribution is taxable under income from salaries, but interest on employees contribution is taxable under income from other sources. So this point was already covered in the chapter of income from salaries. Point number 6 is already discussed. This was covered in the chapter of income from house property. First condition, point number 7 is also discussed. This was discussed in income from house property. If you recollect first condition of income from house property charging section 22, it says there must be property. Property means either building or building along with the adjacent land. So if you are having building or you are having building plus adjacent land, your income is taxable under income from house property. But if you are only having plot of land, then your income is taxable under income from other sources. This was the first condition in section 22 IFSP. Second condition was assessee should be owner of the property. So if Mr. X is the owner, he has let out his property to Mr. Y tenant, then the rent received by X would be taxable under income from house property. Rent received by X would be taxable under income from house property. Now Y is a tenant. Y is letting out that same premises to Mr. Z subtenant. So rent received by tenant from the subtenant is taxable. But since the tenant is not the owner, that is not taxable under income from house property, it is taxable under income from other sources. So rent received by X is taxable under income from house property because he is owner. Rent received by Y is taxable under income from other sources because he is not the owner. So point 6, point 7 already covered in the chapter of income from house property. Point number 8. Point number 8 is nothing but a ground rent. Ground rent means rent for the plot of land. Rent for the plot of land. Point number 9 is income from the activity of owning and maintaining racehorses. See, activity of owning and maintaining racehorses means what? Let me give you an example. You might be knowing that Vijay Mallya, right now he is in UK, na? Government of India is trying to extradite Vijay Mallya to India because he has done some financial scam. That is what government believes. Vijay Mallya made his fortune in 2 things. Number 1, by selling liquor, and number 2, he earned huge sum of money from the business of activity of owning and maintaining racehorses. What do you mean by owning and maintaining racehorses is, this is also covered in the chapter of set off. Owning and maintaining racehorse means Vijay Mallya will purchase the horse. Vijay Mallya will purchase the horse. Say for example, he has purchased the horse for 50 lakh rupees. Now he will look after the he will look after the horse. He will maintain the horse. Means he will provide the food to the horse and stay arrangements will be done. Dietitian will be appointed for the horse. A trainer will be appointed for the horse. Thereafter, horse will be trained rigorously, and then that horse will be ready to participate in a horse race. Now, that horse participates in the horse race. In that horse race, whoever is the audience, out of the audience, some of them would put their bets on the horse. Now, they will do betting. They will do the betting. Now, say for example, Vijay Mallya's horse has won the race. Then those people who had betted money on Vijay Mallya's horse, definitely they have won money. For them, it is winning from horse race. People who betted money on Vijay Mallya's horse, they won the money. For them, it is winning from horse race. But whatever money these people have won now, whatever money these people have won, out of that, some portion of money will be given to Vijay Mallya. Vijay Mallya has not betted money. He has invested his money on a horse, providing training to the horse, etc. Now this horse is participating in the race and that horse has won the race. So all the people who betted money on Vijay Mallya's horse, they have won big amount of winnings. Out of those winnings, some portion of the winning will be given to the owner of the horse. So Vijay Mallya would receive some portion of the winnings. That amount is called as income from the activity of owning and maintaining racehorses. For Vijay Mallya, this activity of owning and maintaining racehorse is a business. For Vijay Mallya, this income from the activity of owning and maintaining racehorse is a business. But still it is taxable under income from other sources. So even though it is a business income, government specifically wants to levy tax under the IFOS. So government says income from the activity of owning the horse and maintaining the horse. Income from activity of owning the horse and maintaining the horse will be taxable under income from other sources. Have you understood this point, point number 9? Yes or no? So let's move on to point 10. Point 10 talks about interest on income tax refund. Interest on income tax refund. See, for example, your tax liability is 1 lakh rupees. For example, your income is 10 lakhs. Then your basic tax liability will be 1,12,500. If you add 4% cess, your total tax liability, final tax liability will be 1,17,000. Now say for example, your tax liability is 1,17,000, but already TDS of 2 lakh is deducted. Already TDS of 2 lakh is deducted. And that TDS different people have deducted, and that amount of TDS those people have paid to the government on your behalf. So government has already received tax in the form of TDS, tax deducted at source. For example, you have kept a FD with bank, on that FD bank will pay you interest. From that interest they have deducted TDS and they have given this TDS amount to the government of India. So they are paying tax of the depositor. So for example, your tax liability is 1,17,000, but your TDS already deducted by different persons and paid to the government is 2 lakhs. So what is the extra tax in the government's pocket is 2 lakhs minus 1,17,000, that is 83,000. That 83,000 will be refunded to you along with interest. That 83,000 is not an income for you. It is just a refund of the income tax. But on that 83,000, you will also receive interest. That interest is considered as your income and that will be taxable under income from other sources. Point number 1. Sorry, point number 10. Next is point number 11. So here we are having 15 points. So 10 points are already gone. Point number 11. Income from royalty. Income from royalty. Royalty is nothing but fees charged for sharing the technology, for sharing the formula, etc. For example, Suzuki has provided car making technology to Maruti. Suzuki has provided car making technology to Maruti. Maruti, using the technology, is manufacturing car in India. They are selling cars in India. They are earning profits. Out of that profits, some portion of the profits they would pay to Suzuki in the form of royalty. So Maruti is paying royalty to Suzuki. Suzuki has earned royalty. For Suzuki, providing technology to different companies in different countries itself is a business. Itself is a business. So whatever royalty is earned by Suzuki will be taxable under that PGBP. But for example, so royalty earned by Suzuki from Maruti is taxable under that PGBP. Let me give you one more example. Say for example, there is a doctor. Monday to Saturday he is working. Sunday, half day, he devotes to writing the book. So that doctor has written the book, Home Remedy for COVID-19. He has written the book of 150 pages. Everything is explained in detail. Why people are getting this problem of COVID-19 and how it can be tackled. Before you are infected, during you are infected, and after you are cured. Which things you should keep in mind. So this doctor has written the book. This book is published. So publisher will print this book and he will sell this book in the market. He will earn profit. Out of that profit, that publisher will give some royalty to the doctor. Writing a book is not a full-time profession for the doctor. For him it is a part-time activity. So royalty earned by the doctor from the publisher will be taxable under income from other sources. So I gave you two examples. In the first one, royalty is taxable under the head profits and gains of business profession. Whereas in the second one, this royalty is taxable under the head income from other sources. Next is point number 12. Point number 12 is called as annuity. Annuity. Annuity means, the meaning of term annuity is generally annual amounts. It is nothing but annual amounts. You have received annuity either under a will or under a contract or under a trust deed. Whatever annuity you receive, that would be taxable under income from other sources if that annuity is received under a will, under a contract or under a trust deed. For example, there is an individual, Mr. Manoj. There is an individual, Mr. Manoj's son. Now say for example, Mr. Manoj died. Mr. Manoj died. Now we have Mrs. Manoj here. Before death, he has made a will. Before the death, Mr. Manoj has made a will. In that will, he says that I am transferring all my property to my child. I am transferring all my property to my child. But there is one condition. Child should pay 25,000 per month to his mother. For the maintenance, child should pay 25,000 per month to his mother. In that case, mother is receiving annuity, and this annuity is received under a will. This annuity would be taxable to mother under the head income from other sources. So this is called as annuity received under a will. You can receive annuity under a contract also or trust deed also. For example, you have acquired deferred annuity plan of LIC of India. Then once the term of that plan comes to an end, you would receive annuity from LIC. That annuity is taxable to you under income from other sources. Next is pension and family pension. Here we need to also discuss section 10 clause 18 and section 10 clause 19. Everything is summarized here in the form of a small flow chart. So we'll try to understand this from this flow chart. This flow chart is explaining you two things. Number one, what is the treatment of pension, and number two, what is the treatment of family pension. See, what is the treatment of pension? That is in fact already discussed with you in the chapter of income from salary. In the chapter of income from salary, I had explained you uncommuted pension and commuted pension. Uncommuted pension is called as monthly pension. It is taxable in case of government employees as well as non-government employees. Whereas commuted pension, also called as lump sum pension, if it is received by government employee, it is totally exempt from tax. If commuted pension is received by a non-government employee, if gratuity was received by him at the time of retirement, then how much? 1/3 is exempt, 1/3 of total commuted value. If gratuity was not received by him at the time of retirement from his employer, then 1/2 of total commuted value is exempt. This is already discussed with you in the chapter of income from salaries. But while discussing this pension with you in the chapter of salary, the important point was, there the pension was received by employee from the employer. In other words, there was a employer-employee relationship between payer and payee. There was an employer-employee relationship. See, you can also invest money in the pension schemes of bank and financial institution. Like LIC of India is having a pension plan. You invest money in that pension plan for a long span of time, say 20 years, 25 years. And once you retire, you would receive pension from the LIC. So here there is no employer-employee relationship between you and LIC. You were an investor, you invested money in the pension fund. Now after your retirement, you are receiving pension. There is no employer-employee relationship here. So that pension which you receive from mutual fund or financial institutions, that would be taxable to you under the head income from other sources. So here I have written pension received from employer is taxable under income from salary, whereas pension received from financial institution is taxable under income from other sources. So pension received from financial institution, mutual fund, etc. is taxable under income from other sources. Now left hand side, listen to me carefully. Left hand side we have a section 10 clause 18. In fact, this is the section of exemption. This I would have covered in the chapter of salary, but intentionally I am covering in the chapter of income from other sources. Here, an individual is working as a part of military or a paramilitary force. Individual is working as a part of military or paramilitary force. See, people working in the military and paramilitary forces, when they have, say for example, fight with some other nation, then if particular person who was working as a member of military or paramilitary forces, he might be given some award for display of his bravery. Say for example, one military personnel was deputed at the India-Pakistan border, and there was a fight between the Indian soldiers and Pakistani soldier. The Indian soldier, say, killed 3-4 Pakistani soldiers, and his entire body was affected in that incident also. So, for display or showcase of his bravery, Government of India may give him some award. Such kind of awards are given. So, say for example, we have something called as Paramveer Chakra. We have something called as Paramveer Chakra, Mahavir Chakra, Veer Chakra, or such other gallantry awards. So, if you are an individual, you are working with the military, paramilitary forces, and for showcase of your bravery, you have received an award, Veer Chakra, Mahavir Chakra, Paramveer Chakra, or some other gallantry award. In such case, after your retirement, whatever pension you receive, after your retirement, whatever pension you receive, that pension will be totally exempt from tax in section 10 clause 18. That pension would not be taxable at all, it will be totally exempt from tax in section 10 clause 18. So left hand side pension story is over. Now we move on to right hand side, that is family pension. What do you mean by family pension? Family pension is nothing but a pension received by the family after the death of an individual. Pension received by family after the death of individual. After the death of husband, wife would receive pension in certain cases. In case of government jobs, after the death of husband, wife would receive pension till wife is alive. That is called as family pension. Family pension is received by the spouse or by the children for their maintenance. So, if you were working as part of military, paramilitary forces and you were awarded Veer Chakra, Paramveer Chakra, Mahavir Chakra, etc., then after you retire, when you receive pension, that pension would be exempt from tax in section 10 clause 18. And after your death, if your family receives family pension, that family pension will also be exempt from tax in section 10 clause 18. So pension is exempt, family pension is also exempt in case of those individuals who were working as a part of military force and they were given any award. Dikshit, yes. After the death of husband, half of the pension is received. In certain cases, if the education of children is not over, in that case, children would also receive some pension for meeting the cost of education. Next is, say for example, some person is working as a part of paramilitary military forces and he has died in performance of his operational duties. There was a fight between two nations. In that fight, few Indian soldiers lost their lives. In that case, Government of India would give family pension to their families. And that family pension will also be totally exempt from tax. So family pension received by widow or children or nominated legal heirs of a member of armed forces of the central government, including the military forces, in the case of death of such member in case of operational duties, if some person has died in performance of operational duties, then his family would receive the pension and that pension received by his family would be totally exempt from tax in section 10 clause 19. Now friends, let's move on to the last part of this family pension. Say for example, Manoj was working as an employee of government. Manoj was working as an employee of government. Manoj has retired. Manoj was working as an employee of government. He was not working as a part of military, paramilitary forces. He was working as a part of government only, some other government department. After Manoj retires, he would receive pension, monthly pension. That monthly pension is fully taxable. That monthly pension is fully taxable. If Manoj commutes the pension, that commuted pension would be totally exempt from tax. After the death of Manoj, his family would receive the pension. That family pension would be totally taxable under the income from other sources. So here, the family pension is received by the family of that employee who has died naturally and he was not forming part of any military or he was not a military or paramilitary personnel. In that case, family pension is taxable. So other cases means you were not part of military paramilitary forces, or maybe you were part of military paramilitary forces but you did not receive any award from the government. In that case also you will fall into other case. In that case, after your death, if your family receives the pension, that family pension would be taxable under income from other sources. But while ascertaining the taxable amount, you will get some deduction under section 57. You will get some deduction under section 57. That deduction would be lower of following two amounts. See, your lower word is missing. You can write that. Lower word is missing here. Deduction would be lower of following two amounts. Please write these words. Deduction would be lower of following two amounts. Number one is amount received into 1 by 3. Amount received into 1 by 3. 1/3 of whatever amount is received as family pension. And number two is maximum deduction 15,000 rupees. Out of 1/3 of amount received of 15,000, you have to select whichever is lower. That would be the amount of deduction. That would be the amount of deduction. You deduct that amount and the balance amount would be taxable family pension, which would be taxed under the head income from other sources. This would be taxed under the head income from other sources. So this is also done. This note is in connection with that pension only. I will not read the entire paragraph, I will just read the heading and you will understand what is written inside the in the paragraph. Exemption of disability pension granted to disabled personnel of armed forces who have been invalidated on account of disability attributable or aggravated by such service. See, if an individual is working as a part of armed force and say for example, he was working as a part of armed force in a fight between two nations, few soldiers they are not died but they have become disabled. Someone has lost his hand, or say for example, in someone's hand grenade has blasted, so he has lost his hand. So he has to retire now because his disability is aggravated due to his service. Disability is attributable to his service. In that case, whatever pension he receives will not be taxed. Whatever pension he receives will not be taxed. This is circular number 13 of 2019 dated 24 June 19. Next is point number 4. Agricultural income. You know that agriculture income is exempt from tax. We have learned a separate chapter on that agriculture income. But agriculture income is exempt from tax provided it is earned from an agricultural land situated in India. What if you earn agricultural income from outside India and you are ordinary resident in India? If you are resident and ordinary resident in India, then your global income is taxable in India. Na? Your scope of income is wider. So that foreign agriculture income will come within the purview of the scope of your income. And foreign agriculture income is not exempt in section 10 clause 1. It is totally taxable. So agricultural land from agriculture income from agricultural land situated in India is exempt in section 10 clause 1, but agricultural land from agriculture income from agricultural land situated outside India is fully taxable. See, I have taken you through 14 points. All these points are illustrative in nature. All these are illustrative, meaning thereby you can have few more points here. Point 15 says any income chargeable to tax under this head, but not falling under 4 preceding heads of income. Any income which is chargeable to tax under this head, but it is not falling into 4 preceding heads of income, can also fall into section 56 subsection 1. It can fall into section 56 subsection 1 and tax can be levied. So with this, we have completed our discussion with respect to section 56 subsection 1, and referring to section 56 subsection 1, you know that lot of points you already knew. They were covered in other chapters. Now we would move on to section 56 subsection 2. This is also a charging section, but section 56 subsection 2 is giving you the list of incomes which are specifically taxable under the income from other sources. Section 56 subsection 2 is giving you the list of incomes which is specifically taxable under income from other sources, and we have an exhaustive list of those points. We have a exhaustive list. So we have 12 points. We have 12 points. Out of 12 points, 2 points are already discussed with you. 2 points are already discussed. Point number 14 is taxable under IFOS. Yes. Agricultural income from agricultural land situated outside India is taxable under IFOS. Even if it is your business to do agriculture, then also your income will be taxable under IFOS only. One more point I told you now. Even if it is your business to earn income from activity of owning and maintaining racehorse, that income will also be taxable under IFOS. So income from activity of owning and maintaining racehorse and income from agricultural activities outside India on a agricultural land situated outside India, these incomes will always be taxable under IFOS. Yes, is that very clear? Yes or no? Shall I proceed, Dikshit? Are you all getting my voice? Sarvana, doing agriculture activity can be business also, no? Agricultural activity can also be business. In that case, your agri income will be taxable under that PGVP. Sorry, agri income should be ideally taxable under that PGVP, but it will not be taxable under that PGVP, it will be taxable under that IFOS. Income earned from agricultural land in India is not taxable at all. We are talking about income earned from agricultural land situated outside India. It will be taxable under IFOS, not under that PGVP. Now let's move on to section 56 subsection 2. Here we have an exhaustive list of 12 points. Exhaustive list of 12 points. Out of this, some points are already discussed with you. So I would mark those points which are already covered in other chapters, and those we will not repeat once again. For example, you refer to point number 6. Income from letting of plant machinery furniture along with building, and letting of building is inseparable from letting of plant machinery furniture. Do you remember where we covered this? We covered this point number 6 in the chapter of income from house property, in the concept of composite rent. Composite rent. Same flowchart I have given here once again. In these notes I have covered I have covered same flowchart once again. See this point number 6. Same flowchart taken from the IFHP chapter. So this point IFHP is covered, already covered in IFHP. So I am not going to repeat this. So point number 6 is already over. Point number 9 and point number 10, these are also over. Point 9, point 10, both were covered where? In the chapter of capital gains. Interest received on compensation or enhanced compensation was discussed with you when I discussed section 45, subsection 5, capital gain in case of compulsory acquisition. And then we have point number 10. Sarvana, not 45.2a, 45.5 compulsory acquisition. Forfeiture of advance money received on transfer of capital asset. This I discussed with you when I discussed the section 51. Section 51. So point number 9 and 10 I would refer right now, just to remind you that yes, these points are over. Point number 10. This is already over. Already discussed in the chapter of income from capital gain while discussing section 51. Same thing I have, same flowchart I have copied here. Point number 9. This is also discussed while discussing section 45 subsection 5. Interest on initial compensation, enhanced compensation is time value of money. Interest is compensated for time value of money. Whatever interest you receive on initial compensation and enhanced compensation, that is taxable under income from other sources, and you get 50% standard deduction. You get what? 50% standard deduction. And that standard deduction is available under section 57 clause 4. Whatever amount of interest is received, of that 50% is standard deduction, balance is taxable under income from other sources. So out of 12 points, 3 are already discussed. So now we are left with 9 points. Now we are left with 9 points. So I'll move on to the first and the most important point, that is dividend income. I'll move on to the first and the most important point, that is dividend income. Before I start the discussion of this dividend income, I would like to remind you that dividend income is already slightly discussed with you. Up to last year, Sarvana, section 8 we will discuss now right now. We will discuss section 8. Section 8 we will discuss, don't worry. Up to last year, whatever dividend was declared by the domestic company, on that dividend, domestic company used to pay tax under section 1150 called as dividend distribution tax, also called as corporate dividend tax. And that dividend was totally exempt from tax in the hands of shareholder in section 10 clause 34. So up to last year, tax on dividend was paid by the company and that dividend was exempt in the hands of shareholder. This year onwards, section 115O is deleted in budget 2020. Section 10 clause 34 is also deleted in budget 2020. Therefore, this year onwards, company will not pay any dividend distribution tax. Shareholder will not get any exemption. This dividend will be taxable totally in the hands of shareholder. So keep in mind that dividend will be taxable in the hands of shareholder. So in connection with dividend, section 56, subsection 2, clause 1. In connection with dividend, how many sections we are supposed to discuss? First is section 8. Section 8 gives you the chargeability criteria of dividend. I told you at the beginning of this chapter that income from other sources, income is taxable based on method of accounting followed by assessing. But there I told you that dividend income is taxable as per section 8. So section 8 gives you the taxability criteria for charging tax on dividend income. Then we have something called as deemed dividend. In Income Tax Act, we have something called as deemed dividend. So in deemed dividend, we have section 2, clause 22, subclause A, section 2, clause 22, subclause B, section 2, clause 22, subclause C, section 2, clause 22, subclause D, and we have section 2, clause 22, subclause E. All these things we need to discuss along with charging section for dividend, section 56, subsection 2, clause 1. Along with that, we need to also discuss section 57. Section 57 is for allowing deduction. For allowing deduction for the expense. So these things we need to discuss in dividend income. Let us start with our discussion. Section 8 is the section which is giving you the taxability criteria of dividend income. It gives you the taxability criteria of dividend income. In accountancy, you might have come across final dividend and interim dividend. Final dividend is paid for the financial year. Interim dividend is a dividend paid between two final dividends. So we say that final dividend is taxable in the year in which it is declared in the AGM. Final dividend is taxable in which year? Final dividend is taxable in the year in which it is declared in the annual general meeting. You might be aware that final dividend directors will propose the dividend. Then annual general meeting will be called. In that annual general meeting, shareholders will approve the payment of final dividend. Once it is approved, the actual payment will be done. So, this final dividend has to go through the process of approval by the shareholders. So, the year in which this annual general meeting is held, the year in which this dividend is declared, dividend is said to be declared only when it is approved by the shareholders in the annual general meeting. So, the year in which this dividend is actually declared, in that year taxability will arise. For example, board meeting for the financial year 2021 would be held in the next financial year 21-22. Board meeting, they will propose the dividend, then they will call the annual general meeting. In that annual general meeting, shareholders will approve the dividend and dividend will be paid in the next year. So, dividend of profits earned by the company during financial year 2021 would be declared in the AGM in the next year, that is financial year 21-22. In which year it should be taxed? Should it be taxed in the year 2021 or should it be taxed in the year 21-22? So, answer is it should be taxed in the year 21-22. That is the year in which it is declared in the AGM. Interim dividend is taxable in the year in which this dividend is unconditionally made available to shareholder. Interim dividend is taxable in the year in which this dividend is unconditionally made available to shareholders. Unconditionally made available means payment is made. Unconditionally made available means payment is made. In other words, interim dividend is taxable on payment basis. Interim dividend is taxable in the year of actual payment. So we have understood the taxability criteria of final dividend and interim dividend. You know that interim dividend, in case of interim dividend, directors will propose the dividend and then shareholders will approve the dividend. Such things will not happen. Interim dividend will be paid when company has earned some extra profits. In that case, director will directly declare the dividend. Approval of shareholder is not required at all. So interim dividend, we say it is taxable in the year in which it is paid to the shareholder, when it is unconditionally made available to shareholder. Now friends, we need to discuss something about deemed dividend. Say for example, there is a company, there is a shareholder. You think about a situation up to the last year. Don't think about the situation in the current year. Think about the situation which was prevalent in the last year. Means company used to pay dividend distribution tax by applying the provisions of section 1150, and shareholder used to get exemption in section 10 clause 34. Now listen to me very carefully. Long back, I'm talking about around 15-17 years back. Before 15-17 years, dividend was taxable in the hands of shareholders only. There was nothing called as dividend distribution tax. Dividend was taxable in the hands of shareholders only. But shareholders were evading the payment of tax, and it was not possible for the government to trace each and every shareholder. It was not possible for the government also to scrutinize each and every income tax return, because government does not have that much amount of resources that they will ask the income tax officers to verify the income tax return of each and every individual. That is not possible. Therefore, government came out with an idea of dividend distribution tax and said that now onwards we will not take tax on dividend from the shareholder, we will take tax on dividend from the company itself, and hence came the dividend distribution tax concept. So earlier shareholder used to pay dividend, earlier shareholder used to pay tax on dividend, then company was asked to pay tax on dividend. Since company was asked to pay tax on dividend, different companies came out with different ideas of avoiding the payment of dividend distribution tax. Now my very simple question to you is, what do you mean by dividend? What is the meaning of dividend? What do you mean by dividend? You would say profit distributed to the shareholder is dividend. You would say profit distributed to the shareholder is dividend. But how do you distribute profit? How do you distribute profit? Say for example, company has called up annual general meeting. All the shareholders attended the annual general meeting. The annual general meeting went up for 6 hours. During those 6 hours, shareholders started shouting, break, break, break. So, break was given during that annual general meeting. During the 30 minutes break, snacks and tea was arranged for the shareholder free of cost. So, company is giving free of cost snacks and tea to the shareholder. Should that be considered as dividend? Because company is not giving snacks and tea free of cost to everyone, only to the shareholders during the meeting. Should that be considered as dividend? So Akshaya madam says no, that should not be considered as dividend. Deva also says no, that is not dividend. Then what do you mean by dividend? What do you mean by dividend? Dikshit says it is appropriation of profit. So my question to you is, how do you appropriate the profit? Akshaya says it is return on investment, return on income. Well, that all these things I understand. But the point is, how do you give dividend? Yes? Giving dividend means what? How would you give dividend? Will you distribute 5 masala dosa to each and every shareholder? No, na. Say for example, if I give 5 masala dosa to each and every shareholder free of cost, will that be considered as dividend? Now the answer has come. Dividend means monetary. Money should be given to the shareholder. Money should be given to the shareholder based on the profit and based on their respective shareholding. So when you give money to the shareholder, definitely it is dividend. So if company gives money to the shareholder, it is dividend. On this dividend, company will be required to pay the dividend distribution tax and shareholder will be exempted from tax. This was the situation up to last year definitely. This year onwards, once again, tax on dividend is required to be paid by the shareholder because now government is confident that now it is possible for us to trace each and every shareholder to find out that who has earned how much amount of dividend. Because of technology, most of the transactions are happening through the bank accounts. Dividends are transferred directly to the bank accounts. TDS will be deducted. So we'll have the TDS, we'll have the PAN number of the investor. So now it is not difficult for us to trace which people have earned how much dividend. In those olden days, it was very difficult to trace. That was the reason of introducing dividend distribution tax. Now it is not impossible to trace, it is very much possible. That is the reason government has removed dividend distribution tax and from this year onwards dividend will be taxable in the hands of shareholder. But I am talking about a situation, when the dividend distribution tax was introduced for the first time. When the dividend distribution tax was introduced for the first time, general meaning of dividend as per the Companies Act is money given to the shareholder is dividend. Money given to the shareholder is dividend. Now you listen to me very carefully. This is the balance sheet of the company. This is the balance sheet of the company. Say for example, name of company is X Limited. Name of company is X Limited. So this is the balance sheet of X Limited. In the balance sheet asset side, you are having a cash bank balance. From that cash and bank balance, if you give money to shareholder, definitely it is dividend. In that case, company was asked to pay dividend distribution tax and shareholder got the exemption. But company wanted to avoid the payment of dividend distribution tax. Company wanted to avoid the payment of dividend distribution tax. So what company will do now? There is a stock exchange. From the stock exchange, bank balance will be used to acquire the shares. Company has acquired shares of Reliance Industries Limited. After this transaction, in the balance sheet asset side, you will have investments in shares of Reliance Industries Limited. Now what this company will do, this investment in shares of Reliance Industries Limited, now these shares will be given to the shareholder. Shares of Reliance Industries Limited X Limited is giving the shares of Reliance Industries Limited to its own shareholders free of cost. Should this be considered as dividend? Because the general meaning of dividend in the Companies Act is money given to the dividend out of the profit is dividend. Money given to the shareholder out of the profit should be considered as dividend. Here the company used to claim that we have not given money, we have given the shares of some other company. This should not be treated as dividend. So we are not liable to pay any dividend distribution tax. And in this manner, this company X Limited avoided the payment of dividend distribution tax, saying that this distribution of shares free of cost should not be considered as dividend. The government came across a lot of such instances. So government concluded that these companies have an intention of evading the tax on dividend. So government said that, do you believe that this is not dividend? Company said, no, this is not dividend. Because dividend means what? Money. So government says this distribution will be considered as deemed a dividend. This distribution will be considered as deemed dividend. And hence government came out with a section of deemed dividend, saying that following distribution will also be considered as dividend. Hence came into place the definition of deemed dividend in section 2, clause 22, subclause A, subclause B, subclause C, subclause D and subclause E. 5 subclauses were inserted. Have you understood the background as to what this deemed dividend is? Why the concept of deemed dividend was introduced? Why the government was forced to come out with this concept? Because the companies were evading the dividend distribution tax. Therefore, government was forced to come out with the concept of deemed dividend, and this deemed dividend is taxable in the previous year in which it is distributed or paid. This deemed dividend is taxable in the year in which it is distributed or paid. Now, to understand the concept of this deemed dividend in detail, to understand section 2, clause 22, subclause A, B, C, D and E, we are going to take an example of balance sheet of one company. Yes, have you understood till now? So, I am taking an example of a company. I am giving you the balance sheet of the company. In this balance sheet, I have taken some numbers. Using these numbers, we will try to understand the concept of deemed dividend. See, in the balance sheet asset side, you are having fixed asset of 100, investments of 50 and current assets of 100. Now, let me clearly say that in these current assets, you only have one thing, and that is bank balance. You only have one thing, that is bank balance. On the liability side, you have share capital. In that you have original shares, means issued to the investors and they have given money for this. Number 2 is bonus shares, issued to the existing shareholders free of cost. So total share capital is 140, reserves and surplus is 60, current liability is 50, total is 250. Now, you should keep in mind these balance sheet numbers. Again and again I will come to this balance sheet. Let me introduce two terms here before we actually move on to the definition of deemed dividend given in section 2, clause 22. Let me introduce two terms here. First is accumulated profits capitalized. Accumulated profits capitalized. And second term is accumulated profits not capitalized. Accumulated profits not capitalized. See, what do you mean by accumulated profit capitalized? Is nothing but bonus shares. Is nothing but bonus shares. In accounting, you might have learned, na? Issuing bonus shares is also called as capitalization of profit. It is also called as capitalization of profit. So this accumulated profit capitalized is nothing but bonus shares. And accumulated profit not capitalized means divisible profit. Do you understand the term divisible profits? It's an accounting terminology used to denote those profits which are available for distribution or dividend. This divisible profit is part of reserves and surplus. Now in our example, what is my accumulated profit capitalized? Yes. My accumulated profit capitalized is 20. What is my accumulated profit not capitalized? 60. So accumulated profit capitalized is 20. Accumulated profit not capitalized is 60. So you should keep in mind this 20 and this 60. When I use the word accumulated profit, whether capitalized or not, when I use the term accumulated profit, whether capitalized or not, I am talking about how much amount? When I use the word accumulated profit, whether capitalized or not, I am talking about 80. If I use the term accumulated profits, whether capitalized or not, we are talking about 80. We are talking about 80. So you need to remember three things. When I say accumulated profit capitalized, we mean to say bonus 20. Accumulated profit not capitalized is the balance of divisible profit which is part of reserves and surplus 60. And when I say accumulated profit whether capitalized or not, I am talking about 80. So these three terms you should keep in mind. Keeping in mind these three terms, let's now move on to understand what is deemed a dividend. We have 5 subclauses here. In section 2, clause 22, we have 5 subclauses. Subclause A, subclause B, subclause C, subclause D and subclause E. Subclause A says, when a company gives money, cash money to the shareholder, when a company gives money to the shareholder, definitely it is dividend. But even if company has distributed certain assets to the shareholder, that will also be considered as dividend. So subclause A says distribution by the company to its shareholders, which results into release of all or any part of the assets of the company. From the balance sheet asset side, if you give anything to the shareholder, if you give fixed asset to the shareholder, if you give investment to the shareholder, if you give bank out of bank balance you transfer funds to the shareholder. From the balance sheet asset side you give anything to the shareholder, that will result into release of assets of the company in favor of shareholder, and that would be termed as dividend. So if company has given cash, definitely there is resulting into release of assets in favor of shareholder. If company has given other assets other than cash, that will also release some assets in favor of shareholder. That will also be considered as deemed dividend. So other than cash, if some other assets are distributed, for that you have to consider fair market value of those assets. For that you have to consider what? Fair market value of those assets. So whatever cash is distributed, you take that cash into account. Whatever assets are distributed other than cash, for those assets, you take the fair market value right here, then you take the total. Now let me give you the numbers. For example, company has distributed cash. How much? 100. Company has distributed cash and that is 100. Company has also distributed other assets. For these other assets, you have to take fair market value. Now say for example, other assets are having a fair market value of 100. So what is the total distribution by the company? 200. Total distribution by the company is 200. See, other assets in balance sheet it will have different value, but when they are transferred to shareholder, here in this calculation we should take fair market value. Now this 200 which is distributed now is required to be divided in two parts. On the left hand side, we have distribution to the extent of accumulated profits, whether capitalized or not. Can you tell me what is the amount of accumulated profit, whether capitalized or not? Yes, 80. Very good. So out of 200, I would take 80 on the left hand side. So what is the balance left? 120. Balance left is 120. This 80, up to last year, company was required to pay dividend distribution tax on this 80, and this was exempt in the hands of shareholder in section 10 clause 34. Now onwards, this year onwards, on this 80, shareholder has to pay the tax. So I have written here, section 1150 and section 1034 are deleted with effect from assessment year 21-22. Therefore, with effect from assessment year 21-22, dividend is taxable in the hands of shareholders. So what will become taxable in the hands of shareholder is only 80. This 120 will not be taxed. Why 120 will not be taxed? Because from the inception of the company, what is the amount of profits earned by the company? That would be definitely part of reserves and surplus. Either it would be part of reserves and surplus, and if at all some bonus is given, that would also form part of share capital. So we have taken the total of both, 20 plus 60, that is 80. So 80 is nothing but the profits earned by the company right from the inception. And what do you mean by dividend? Distribution out of profits. So this 120 now, this 120 is not distribution out of profits. Then what it is? It is something else, but definitely it is not profit. You may think that the total of the balance sheet is 250. How come this distribution can be 200? Yes, it can be. Say for example, company had purchased land in past years, around 25-30 years back, company had purchased a plot of land for say 1 crore. That plot of land is worth 20 crores today. What will appear in the balance sheet asset side under fixed asset? Only 1 crore will appear, na? Only 1 crore will appear on the balance sheet asset side. You will not revalue that asset. So, if you distribute this plot of land to the shareholder, then in the balance sheet the value is 1 crore. But when you distribute, you have to take fair market value. When you distribute, you have to take fair market value, na? That is 20 crores. So, definitely there can be a distribution of 200. Because here we are taking into account fair market value. So, whatever is appreciation, the profit, appreciation, the value of asset, na, which is not revalued, there is no revaluation reserve on the liability side, reserves and surplus. So, because of that, the distribution amount can be very high. So, this distribution of 120 is not considered as distribution out of profits, because company has profits of only 80 till now. So, this distribution is considered as distribution out of the capital profits. For the shareholder, it is a capital receipt. Capital receipt can be taxed only if there is a charging section. And do we have any charging section for charging tax on capital receipt? Yes, we have. Which head? Income from capital gain. Section 45 subsection 1. But it says there must be a capital asset, there must be transfer of capital asset. Such capital asset should have been transferred during the previous year. These conditions are not fulfilled because shareholder is not transferring anything to the company. Shareholder is not transferring anything to the company. He is just getting something, 120. Therefore, we say this 120 is a capital receipt in the hands of shareholder and therefore it is not taxable. Therefore, it is not taxable. Have you understood this? Yes or no? So, section 2, clause 22, subclause A is over. If company distributes anything from the asset side of the balance sheet, if company picks up anything from the asset side of the balance sheet and gives it to shareholder, that will be considered as deemed dividend to the extent of accumulated profits, whether capitalized or not. On that portion, shareholder will be required to pay the tax. Now we have section 2, clause 22, subclause B. Distribution by the company to its shareholder. What is distributed? Debenture stock deposit certificate or bonus shares are given to preference shareholders by the company. See, which debentures? Company is giving its own debentures to own shareholders free of cost. Company is giving its own debentures to its own shareholders free of cost. Company is giving its own debentures, own debenture stock, own deposit certificate to the shareholders free of cost. Generally, debentures are issued and the other person is asked to invest money in the form of debt. But here company is giving this debenture certificate free of cost to the existing shareholders. Here company is giving free of cost bonus shares to preference shareholders. If you give bonus shares to preference shareholders, that is also considered as deemed dividend. So here section 2 clause 22 subclass B, I am dividing in two parts. Part A is distribution to equity shareholders and part B is distribution to preference shareholders. Part A is distribution to equity shareholders and part B is distribution to preference shareholders. Let us first talk about part A. if the company gives its own debenture stock or deposit certificate to the existing equity shareholders, this would be considered as deemed a dividend to the extent of accumulated profits, whether capitalized or not. For example, company has given its own debentures of the value of 200 to the existing shareholders. Then this 200 will be divided into two parts, left hand side, right hand side. Left hand side, how much amount will be taken? Distribution to the extent of accumulated profit, whether capitalized or not. How much it is? 80. In our example, it is 80. So this 80 will be taken to the left hand side. Remaining 120 will be taken to the right hand side. This 120 will not be taxed because it is a capital seed in the hands of shareholder, therefore it is not taxable because the conditions of charging section are not fulfilled. Shareholder is just receiving debenture stock, deposit certificate free of cost. He is not transferring anything to the company. Therefore, this 120 is a capital seed, not taxable, and this 80 is considered as dividend. This will become taxable in the hands of shareholder from this year onwards. Up to last year, on this 80, company used to pay dividend distribution tax. On this 80, up to last year, company used to pay dividend distribution tax. Now let's move to second part. Second part is distribution to the preference holders. Distribution to the preference holders. If company is giving debentures, its own debentures free of cost to its own preference holders, Dixit is asking me a question, when shareholder will receive 80, sir? Dixit, shareholder will not receive 80. Shareholder will receive debentures worth 200. Now all shareholders combined, they would receive total debentures worth 200. Are you understanding? The value of total debentures transferred to shareholder is how much? 200. Dixit, are you understanding? The value of total debentures transferred by the company to the shareholder is 200. Out of that 200, only 80 will be considered as dividend. So only 80 will become taxable. Remaining 120 is a capital asset for the shareholder, no tax on it. Dixit? Yes? Any one of you having any doubt? Shall I proceed? Yes, okay. So company is giving its own debentures, own debenture stock, own deposit certificate or bonus shares to preference holders. That will be considered as deemed dividend. Say for example, debenture stock, deposit certificate, bonus shares worth 200 are given to the preference holders. Out of that, 80 would be considered as distribution to the extent of accumulated profit, whether capitalized or not, will be considered as dividend. Remaining 120 would be considered as capital receipt for the shareholder, no tax, because the condition of charging section of capital gain is not fulfilled. Now, if you could identify, there is one important point here. Bonus given to the equity shareholders is not considered as dividend. Bonus given to the equity shareholder is not considered as dividend. Only bonus given to the preference shareholder is considered as dividend. Why na? Why? If I ask you, who is having right over this reserves and surplus balance? Who will have right over this reserves and surplus balance? Sarvana says normally preference shareholders are not issued bonus. Sarvana, I want to tell you that to avoid the payment of dividend distribution tax, companies were intentionally given, they were intentionally giving bonus to their preference holders. Instead of giving dividend, they used to keep the rate of dividend very low and they used to issue bonus shares frequently to their preference holders. This was done to avoid the payment of dividend distribution tax. This you should always keep in mind in your background, saying that all these things were done for avoiding the payment of dividend distribution tax. Now, if I ask you from this balance sheet, reserves and surplus balance belongs to whom? Yes, reserves and surplus balance belongs to whom? It belongs to equity shareholder. See, whether this reserves and surplus, whether it is forming part of reserves or given to the shareholder in the form of bonus. Even if it is not given to the equity shareholders in the form of bonus, that amount would form part of reserves. Even if that amount forms part of reserves, equity shareholders they are having right over that reserves. Therefore, if you give bonus to the equity shareholders, they are not getting any benefit. Because anyway, that amount lying in the reserves and surplus balance also, they were having the right over it. But preference shares are generally non-participative preferences. So, those preference shares do not have any right in the reserves and surplus balance. But if you give free shares to preference shareholders, those free shares would be equity only. So now your preference holders he has got free equity shares, bonus shares. So now he will also have right, he will also have claim over that reserves and surplus balance. That is the reason here we are saying that if you give bonus shares to equity shareholders, that will not be considered as deemed dividend. But yes, if you give bonus shares to preference shareholders, that would be considered as deemed dividend. That would be considered as deemed dividend only to the extent of accumulated profits, whether capitalized or not. Distribution in excess of accumulated profit anyway is not considered as deemed dividend. So with this we have completed section 2 clause 22 subclause B. See, you should always keep in mind that the clear intention of transferring benefit in different forms by the company to the shareholder was to avoid the payment of dividend distribution tax. Companies used to come out with different ideas of transferring benefit to the shareholders and avoid the payment of dividend distribution tax. As and when government came across such ideas, government inserted different clauses in the definition of deemed dividend with the intention to cover all those situations. So till now we have covered section 2 clause 22 subclause A. Any distribution which results into release of assets in favor of shareholders. Situation B, section 2 clause 22 subclause B. Any distribution of debentures, stock, deposit certificate or bonus shares to the equity or preference holders. To the equity, bonus is not considered as deemed dividend. If it is given to preference holders, it is considered as deemed dividend. Is that very clear? Yes? Okay. Let's now move on to section 2 clause 22 subclause C. Section 2 clause 22 subclause C. Now listen to me very carefully. Section 2 clause 22 subclause A has done what? It has locked the asset side of balance sheet. If you distribute anything from the asset side of balance sheet, we will apply section 2 clause 22 subclause A. Section 2 clause 22 subclause B has done what? It has locked the liability side of the balance sheet. It says if you distribute something from the liability side, like you give free of cost debentures or stock, deposit certificate, etc. free of cost to the shareholders, that would also be considered as deemed dividend. So by making section 2 clause 22 subclause A and subclause B, government has locked the asset side of the balance sheet as well as government has locked the liability side of the balance sheet. Now if you touch either the asset side or the liability side and you distribute something, that would be considered as deemed dividend. So few companies came out with an idea that let us liquidate the company. Like intentionally, private limited companies were liquidated, and at the time of liquidation, see, all this exercise was carried only on a piece of paper. Means old company gets liquidated, new company gets formed, new company will issue the shares to the shareholders and shares of old company will be taken back. All this exercise was done on a paper exercise. Practically, business would remain as it is, everything would function as it is. Just on the books, everything will change. Why this was changed? Because at the time of liquidation, all the assets are given to the shareholders only. At the time of liquidation, all the assets are given to shareholders free of cost, because shareholder is going to return the shares to the company. So in some cases, companies went to the extent of liquidating the company to avoid the payment of dividend distribution tax. And government came out with new clause, section 2 clause, government came out with new subclause, section 2 clause 22 subclause C, to cover the situation of liquidation. Government came out with section 2 clause 22 subclause C. Along with that, government came out with section 46 subsection 1 and section 46 subsection 2 in the chapter of capital gain. In the chapter of capital gain, this section 46 subsection 1 and subsection 2, I have not discussed. I told you that I will be covering in the chapter of income from other sources. So right now it is the right time to get into this. I have a practical question on this. We will solve once we complete this discussion. Now listen to me very carefully. Here there is a company and this company is in liquidation. Company is getting liquidated, and on the other hand we have shareholders. So at the time of liquidation, everything which is left after paying the outside liabilities is given to the shareholders. So cash is distributed to the shareholder, other assets are distributed. For other assets you have to take fair market value. So you take the amount of cash distributed to shareholders, you take the amount of other assets distributed to shareholders. Then you take the total. Whatever is distributed to the shareholder, whatever cash is distributed, plus for other assets you take the fair market value. Whatever other asset distributed, you take the fair market value. That once again will be divided in two parts, left hand side, right hand side. Left hand side is what? Distribution to the extent of accumulated profits, whether capitalized or not. Distribution to the extent of accumulated profit, whether capitalized or not. This will be considered as deemed dividend. So for example, distribution is done for say 300. Distribution is done for 300. What is the amount on the left hand side? Distribution to the extent of accumulated profit, whether capitalized or not, as per our balance sheet, 80. So what is there on the right hand side? 220. 220. So left hand side 80. Last year, up to last year, company used to pay dividend distribution tax on that 80. Now this year onwards, shareholder will have to pay the tax. And right hand side, see, this discussion is similar to section 2 clause 22 subclause A. Here also cash and other assets were distributed. Where there is a change in section 2 clause 22 subclause C as compared to section 2 clause 22 subclause A now. In 222C, company is getting liquidated. Shareholder is returning his shares to the company in exchange of assets. So here the condition of charging section of the capital gain head, section 45 subsection 1 are fulfilled. Is there a capital asset? Yes. Shares returned by the shareholder to the company. The shares are returned by the shareholder to the company at the time of liquidation. Shareholder will return his shares to the company now. Those shares are considered as capital asset. And those shares are returned by the shareholder to the company. That is considered as transfer of capital asset. So there is a capital asset, there is a transfer. This transfer has happened during the previous year. Definitely shareholder will be required to calculate capital gain. Shareholder will be required to calculate capital gain. Now let me tell you, for example, I am a shareholder of this company and I am holding 10% shares. I am a shareholder of the company holding 10% shares. So out of this 300, I would receive how much? If I am a shareholder holding 10% in the company, 10% share capital in the company, out of the total distribution of 300, I would receive how much? I would receive 30. Yes or no? Out of the total distribution of 300, I would receive 10% amount now, because I am a shareholder holding 10% shares. So I would receive 30. Now I need to think from my point of view. This 30 needs to be divided in two parts. This 30 needs to be divided in two parts in the ratio of 80:220. In the ratio of 80:220. Can you give me what is the amount on the left hand side? Yes? Can you give me the amount on the left hand side? How you will get the amount on the left hand side? 30 into 80 divided by 300. Yes, how much it is? 8. Right hand side, 22. Yes or no? Now consider these amounts to be in lakhs. So company has done the total distribution of 300 lakhs. Out of that I have received 30 lakhs. For me, on the left hand side 8 lakhs, right hand side 22 lakhs. This 8 lakhs will be considered as deemed dividend, will be taxable to me under that IFOS. And this 22 lakhs will be taken to the head of capital gain. I'll calculate capital gain. This 22 lakhs will be taken as full value of consideration. And from that full value of consideration, I would deduct my cost of acquisition, or if those equity shares were long-term asset, then index cost of acquisition. And accordingly, I would calculate the amount of capital gain. So out of total distribution of 300, I am a shareholder holding 10% shares. So I have received 30. Out of 30, 8 goes on the left hand side, 22 goes on the right hand side. 8 is considered as deemed dividend, taxable to me under IFOS. 22 is considered as capital asset. Conditions of charging section are fulfilled. There is a capital asset, there is a transfer of capital asset. So I need to calculate capital gain. This 22 would be considered as full value of consideration. I will be calculating capital gain on transfer of equity shares to the company. And this capital gain will be taxable to me under capital gains. Yes? Is that very, very clear? Yes or no? Yes or no? Please respond. Okay. Now listen to me. We also have section 46 subsection 1, 46 subsection 2, section 2 clause 42a. All these things we have. These are pertaining to the chapter of capital gain. But I have not discussed with you in the chapter of capital gain. Section 2 clause 42a talks about what? Period of holding. So period of holding should be taken from which date to which date? Shareholder, while computing capital gain, first of all he has to decide period of holding, whether that capacity is short term or long term. So he has to take the period of holding of those shares from which date to which date? Definitely from the date of acquisition. Up to which date? Should he take up to the date of order of liquidation? If you want to liquidate the company or to take the approval of shareholders, should you take the date of approval by the shareholder? Should you take the date of passing of order by the court for liquidation? Which date you should take? So that is what is written in section 2 clause 42A. While calculating period of holding for determining whether the shares are long term or short term, period subsequent to the date on which company goes into liquidation shall be excluded. See, when the company goes into liquidation, court order will be passed for liquidating the company. You have to take the permission from the court. Court will pass the order, thereafter business will stop completely, and then assets will be sold and liability holders will be paid off. So you should take the period of holding up to the date of liquidation, that is up to the date of passing of order by the court. Thereafter, you might have received money from the company after 6 months also. So that 6 months should not be taken to account. So period subsequent to the date on which company goes into liquidation shall be excluded. This is written in section 2 clause 42A. Section 46 subsection 1 says, when the assets are transferred by way of distribution to the shareholders of a company on account of liquidation, such a distribution shall not be regarded as transfer in the hands of the company. See here, at the time of liquidation, company is also transferring asset to the shareholder. Company is transferring asset to shareholder and shareholder is transferring shares to company. If you consider that both are transferor, company has to calculate capital gain on transfer of asset and shareholder has to calculate capital gain on transfer of equity shares. Then there will be double taxation, because once the company gets liquidated, then company shareholder everything is same only. They are not two different entities anymore. At the time of liquidation of the company, every asset belongs to the shareholder only. So, to avoid this situation of double taxation, section 46 subsection 1 says, when the assets are distributed by the company to the shareholder at the time of liquidation, that will not be considered as transfer for the company. Therefore, company will not be required to calculate any capital gain. Section 46 subsection 2 says what? Section 46 subsection 2 says, distribution of assets by the company to the shareholder at the time of liquidation will be considered as transfer. Capital gain is required to be calculated in the hands of shareholder. What should be taken as full value of consideration? What should be taken as full value of consideration? Total distribution 30 minus distribution to the extent of accumulated profit whether capitalized or not 8. So balance 22 should be taken as full value of consideration for calculating capital gain. That is what is written in this point number 2. Have you understood this? Here they have given you meaning of accumulated profit in case of accumulated profits in case of liquidation due to compulsory acquisition. Have you understood this? Yes or no? Please respond. Now, shall we have a break right now? Yes. So we will have a break till 12 o'clock. We will have a break till 12 o'clock and then we will have a third session from 12 to 2 in which we will complete dividend. Besides that, we will also complete other topics and maybe partly we will complete the gift, and tomorrow's session gift will get over and IFOS chapter will come to an end in the first maximum 2 hours, and then we'll move on to the chapter of deductions from gross total income. So we are having a break right now. All those who are having doubt can ask me right now. Yes, Dikshit, tell me what is your doubt. Page number 237, point number 4 and 10. Page number 237, 241. Dikshit, what is doubt in point number 4? If director has acted as guarantor, company wanted a loan. No bank was ready to give the loan without the guarantee. So director has provided the guarantee by charging some fees. So he has acted as a guarantor and he has charged some fees for acting as a guarantor. That fee is received by director for acting as a guarantor is taxable under IFOS. Yes? Dikshit, what doubt do you have in this point number 4? Second part is, at the time of initial public offer or at the time of further public offer, you know na, you should do undertaking of shares. You should get minimum subscription of 90%. Otherwise, you will not be allowed to issue the shares and raise the capital from the public. So you should have some security na, as a company. So you have to appoint the underwriter. So director, oh, you had a network problem. Okay. So I am explaining you point number 4 once again. Point number 4 is having 2 points. Number 1, director has received some commission for acting as a guarantor. So company wanted a loan from the bank and bank was ready to provide the loan provided company gives some guarantee. Company gets some guarantor. So director has agreed to act as a guarantor for the company. In other words, if company doesn't pay the loan in future, doesn't repay the loan in future, then director will be asked to repay the loan. So director is acting as a guarantor, not free of cost. He has charged some commission. So that commission earned by director for acting as a guarantor would be taxable to director under income from other sources. At the time of initial public offer, further public offer, for raising the funds, you need to appoint an underwriter. Now your director said that I will only act as an underwriter, you pay commission to me. Whatever commission you are paying to outsider, you pay something less than that to me. So your director has acted as a underwriter. So company is paying underwriting commission to the director. In that case, he has received the underwriting commission from the company, taxable under IFOS. Point 10. Point 10 I explained saying that, for example, your total income is 10 lakhs. Your tax liability will be 1,12,500 plus 4% health and education cess. So your tax liability will be 1,17,000. Now say for example, different people paid you income. Different people paid you income. And while paying you income, they deducted the TDS. That TDS, they gave it to the government. So those people have paid TDS to the government. That is nothing but your tax, na? They have paid your tax. So your TDS deducted is 2 lakh rupees. Your TDS deducted is 2 lakh rupees. But your tax liability is only 1,17,000 rupees. So in that case, what will happen? You will get a refund of 83,000. You will get a refund of excess income tax paid 83,000. On that 83,000, you will also get some interest. That interest is taxable under income from other sources. Yes, Dikshit, have you understood? Yes, anyone else is having any doubt? 11 point number 11. Sarvana, I gave you example of that Maruti Suzuki na. Suzuki company has provided car making technology to Maruti. Maruti will make the cars using the technology in India. They will sell the cars in India. They will earn the profit. And for using the technology of Suzuki, Maruti will pay royalty to Suzuki. That royalty is a income from business profession for Suzuki. Because for Suzuki, sharing the technology and earning the income is a business. So, regular basis, yes. If it is a business, it is always on regular basis. So, that royalty is taxable under that PGVP. I give one more example saying that there is a doctor who has written a book, How to Home Remedy for COVID-19. What to do before getting infected, what to do during the period when you are infected, what to do after getting cured. So that doctor has written a book on Sunday in his free time. That book is published and income is earned, royalty income. Publisher has paid royalty to the doctor. So for doctor, writing this book is not a main profession. He has written in free time. So that will be considered as his income from other sources. Dikshit says page number 242, point number 4. Dikshit, point number 4 I did not explain because point number 4 generally it is not asked in the examination. Point number 4 says, point number 3 is period of holding. Period of holding says any period after the date of liquidation of company should not be taken into account. For example, court has passed the liquidation order on 30th June. Court has passed the liquidation order on 30th June. Now after 30th June, company will not do any business. Company will appoint the liquidator. Liquidator will start selling of the assets. He will realize money. He will pay off the outside liabilities. Whatever balance is left, he will pay to the shareholders. But all these things would take time, na? So shareholder actually received money, say only on 31st December. And shareholder has returned his shares to the company on 31st December. So shareholder is returning the shares on 31st December. He is receiving some money or other assets from the company on 31st December. But the date of liquidation, the order of liquidation was passed by the court on 30th June. So you should take the period of holding up to 30th June or you should take the period of holding up to 31st December. That is the question. So we are saying that you should take the period of holding up to 30th June. Have you understood? You can read this question. I am giving you 1 minute's time. Go through this question, question number 6. Are you getting the voice? Yes or no? Okay, let me read the question for you. Quickly we'll go through the question and orally you need to give me answers. Pick up your calculators, be ready, give me the answers. Solution will be provided to you, don't worry about that. I think question number 6 solution might be already there. Yes, it is there in the textbook. Don't look at that. Pick up the calculators. Let's do the calculation. Question number 6 says, Miss Vasumati purchased 10,000 equity shares of Rajesh Company Private Limited on 28th of February 2015. This Rajesh Company Private Limited is a private company. Shares of private company are not listed. So they belong to second category of capital set. Period of holding applicable is 24 months. And Vasumati, Miss Vasumati had acquired 10,000 shares. This were acquired at 1,20,000. 1,20,000 is the cost of acquisition. The company was wound up on 31st July 20. On 31st July 20, this was their balance sheet. So balance sheet asset side, they have agricultural land 42 lakhs. Cash at bank 6.5 lakhs. Total is 48 lakh 50,000. Liability side, they are having 60,000 equity shares of 10 each, 6 lakhs. So out of 60,000, Miss Vasumati is holding how many shares? 10,000 shares. So can I say she is holding 1/6 the shares? Yes or no? Out of 60,000 shares, total shares of the company are 60,000. Out of 60,000, if Miss Vasumati is holding 10,000 shares, that is nothing but 1/6 the shares. So at the time of liquidation, whatever is distributed to the shareholders, Miss Vasumati would receive 1/6 the share in that. She would receive 1/6 the share. General reserve balance is 40 lakhs. Provision for GST is 2 lakh 50. Provision for GST is 2 lakh 50. Liability towards GST is ascertained at 3 lakhs. Liability towards GST is ascertained at 3 lakhs. So can you tell me provision is created only for 2.5 lakhs, but the actual liability is ascertained at 3 lakhs. So what we need to do? We need to create more provision to the extent of 50,000 rupees. So how do we do that? We will reduce the balance of reserves and surplus and we would create the provision. So this balance sheet, these numbers are required to be revised. This provision for GST, 2 lakh 50 I need to cancel and I need to make it as 3 lakhs. Yes or no? The reserves and surplus balance of 40 lakh needs to be revised. The new balance should be 39 lakhs 50,000. Yes? Is that very clear? Now they say the remaining assets. Remaining assets. What do you mean by remaining assets? They have used the word remaining assets. What do you mean by remaining assets? Remaining asset means after paying of the liability. After paying the liability of GST. Liability of GST is 3 lakhs. After repaying this 3 lakhs, remaining assets are distributed to the shareholders in a proportion of their shareholding. Cash balance of bank balance, cash at bank 6.5 lakhs. Out of 6.5 lakhs, GST needs to be paid to the tune of 3 lakhs. So what is the balance amount of bank balance? 6.5 lakhs minus 3 lakhs is 3.5 lakhs. The market value of 6 acres of agricultural land in urban area on 31st July 20, that is the date of liquidation, is 10 lakh per acre. So that agricultural land which you are seeing on the asset side balance sheet, it's an urban agricultural land. It is how many acres? 6 acres. Six acres. This 6 acres of agricultural land. What is the market price of 1 acre? Market price of 1 acre is 10 lakhs. The agricultural land received above was sold by Ms. Vasumati on 28th of February 21 for 15 lakh. Discuss the tax implication in the hands of the company and in the hands of Ms. Vasumati. What is the tax implication in the hands of the company? Yes, there are no tax implications in the hands of the company. As per section 46 subsection 1, at the time of liquidation, if the company has distributed assets to the shareholder, it is not considered as transfer in the hands of the company, no capital gain tax in the hand of the company. What is the treatment in the hand of the shareholder? Whatever amount he has received will be divided in 2 parts. Number 1, left hand side, distribution to the extent of accumulated profits, whether capitalized or not. Right hand side, distribution in excess of accumulated profits. Now you give me the numbers. You give me the numbers. Listen to me carefully. There are 60,000 shares of the company. There are 60,000 shares. Entire company, 60,000 shares. Basumati, she is holding how many shares? 10,000 shares are held by Miss Vasumati. Now listen to me carefully. Can you tell me what is the bank balance? Bank balance 6,50,000. Out of that, you have to set aside 3 lakh for GST. So the balance amount is 3,50,000. This 3,50,000 will be distributed to the shareholders. Besides that, you have the agricultural land, 6 acres. This will also be given to the shareholder. So my question is, how much amount Miss Vasumati would receive? She would receive 1/6 of 3,50,000, yes or no? 3,50,000 into 1/6, because she is holding 10,000 out of 60,000 shares. So 1/6 of 3,50,000 is how much? 58,333. Agricultural land, she would receive 1 acre. What is the value? 10 lakhs. So what is the total value? 10,58,333. This 10,58,333, this needs to be bifurcated in two parts. Left hand side, distribution to the extent of accumulated profits, whether capitalized or not. Can you tell me what is the amount of accumulated profit of the company? 39,50,000. Yes or no? Yes or no? It was 40 lakhs. Then you used 50,000, na? You created provision for GST. So the revised amount is 39,50,000. What would be the share of Miss Vasumati in this 39,50,000? Would be 1/6. That will be how much? Yes? Are you getting the numbers? Are you understanding? So the left hand side value will be 6,58,333. On this, tax will be levied where? IFOS. Right hand side balance will be how much? 10,58,333 minus 6,58,333 is 4 lakhs. This 4 lakh is considered as full value of consideration in capital gain. This 4 lakhs will be considered as full value of consideration in capital gain. From this 4 lakh you have to deduct what? Indexed cost acquisition. What is the cost acquisition? Given the question 120. Index number of the year of transfer 2021 is 301. What is the index number of the year of acquisition? Shares were acquired in which year? 15-16. Sorry, 14-15. 14-15. What is the index number of 14-15? 240. So get me the index cost acquisition. 1,20,000 into 301 divided by 240 is how much? 1,50,500. Now get me the amount of long-term capital gain. 4 lakh minus 1 lakh 50,500 is 2 lakh 49,500. Yes. Have you all understood the calculation? Yes or no? Yes, very good. So with this question number 6 is gone. Question number 6 is over. See, I have most of the concepts. Now, most of the concept, I have a practical question so that you have a better understanding of the provisions. So let us move back to section 2, clause 22, subclause C. This is the manner in which you have done the calculation, left hand side, right hand side. 658, 333 would be taxable to shareholder. Up to last year, on that amount, company used to pay dividend distribution tax. This year onward, that amount would be taxable in the hands of shareholder. So what is the amount of left hand side? 658, 333. Right hand side balance 4 lakhs. So you calculate IFOS, how much is taxable under IFOS and how much is taxable under capital gain. Next is section 2, clause 22, subclause D. Section 2, clause 22, subclause D. Here the company is in internal reconstruction. Company is in internal reconstruction. Do you understand the internal reconstruction? Capital reduction. Have you completed the chapter of internal reconstruction in accountancy? Yes. So what happens in case of internal reconstruction? Face value of the shares of the company are reduced. So shareholder has to sacrifice in the face value. So generally which company's internal reconstruction would take place? Loss-making company. Those loss-making company whose chances of revival are bright. Those loss-making company whose chances of revival are bright, in those cases they can go for internal reconstruction. They can go for what? They can go for internal reconstruction. So if the company is going into internal reconstruction, shareholder has to sacrifice. Shareholder has to sacrifice. With the intention to avoid the payment of dividend distribution tax, only with an intention to avoid the payment of dividend distribution tax, companies used to intentionally do the internal reconstruction. Even the profit-making company used to do the internal reconstruction. Why? So that they can distribute something to the shareholder without payment of dividend distribution tax. So the clear intent was to transfer something to the shareholder and avoid the payment of dividend distribution tax. So even the profit-making companies, they were doing the internal reconstruction. So government came to know about this and therefore government inserted one more provision, section 2, clause 22, subclause B, saying that even in case of internal reconstruction, you will have to calculate what is the amount of dividend, what is the amount of capital gain. So let's move on to this section 2, clause 22, subclause D. On the left hand side, we have company which is going through internal reconstruction. Right hand side, we have a shareholder. Company has distributed some cash. Company has distributed some assets. For those assets distributed, we will take the fair market value of the assets distributed. We take the total. Then this total should be bifurcated in two parts. For example, total amount distributed by the company is say 300. Distribution to the extent of accumulated profit, whether capitalized or not, as per our balance sheet example is 80. So 80 will move on to the left hand side. What goes to the right hand side is balance 220. Now, let us take the same example of Miss Vasumati. Same example of question number 6. I will take and make you understand what will be the difference here. Miss Vasumati was holding 10%, 1/6 share, na? So how much she would receive? Same example here. Now I am taking the numbers of the question to make you understand. You can keep question number 6 in front of you. I'll be using these numbers only. So tell me, what is the total amount of distribution by the company? Yes? Total amount of distribution is how much? 3,50,000 bank balance and 6 acres of agricultural land. How much amount Miss Vasumati received? 58,333 and 10 lakh is the fair market value of agricultural land. Let us take the same numbers and let us say that there is no liquidation of company. There is only reduction in the value of shares. Face value is reduced from say 10 rupees to 5 rupees. Face value is reduced from 10 rupees to 5 rupees. Now you tell me, what is the total distribution? What is the amount distributed, or what is the amount received by Miss Vasumati? 10 lakh 58,333. Out of 10 lakh 58,333, how much amount will go to the left hand side? 6 lakhs 58,333. This amount would be taxed to her under income from other sources. This amount would be taxed to her under income from other sources. What will be the amount on the right hand side? 1058,333 minus 658,333, that is 4 lakhs. 4 lakhs would come here. This 4 lakhs would be considered as full value of consideration. For example, expense on transfer is 0. So net consideration is 4 lakhs. Net consideration is 4 lakhs. Now tell me what we took it as cost of acquisition. Cost of acquisition was how much? 1,20,000. 1,20,000. But that was because of liquidation, na? Right now in this example there is no liquidation. The face value of shares is getting reduced from 10 rupees to 5 rupees. Face value of shares is getting reduced from 10 rupees to 5 rupees. So old face value is 10 rupees, new face value is 5 rupees. What is reduction in the face value? What is reduction in the face value? Yes, 5 rupees. 5 rupees. Or if you are getting confused, let me say that old face value was 10 rupees, new face value is say 6 rupees. So what is the reduction in face value? 4 rupees. 4 rupees is the reduction in face value. So you find out the proportionate amount of your value of investment. Your value of investment was 1,20,000. You multiply this value of 1,20,000 by amount of reduction in face value, that is 4 rupees, divide it by face value before reduction. So you'll get how much? 48,000. So the entire cost should not be deducted here. Only to the extent of 48% should be, only to the extent of 40% it should be deducted. So it is 48,000. So what should be taxed under income from capital gain is 3,52,000. Definitely, if it is long-term asset, we need to also apply the indexation. So you can simply say that section 2 clause 22 subclause C and section 2 clause 22 subclause D, they are replica with one change. Section 222D is similar to 222C with one change. What is that one change? Here in cost of acquisition will not take the entire amount, will take the amount only to the extent there is a reduction in face value. Only to the extent there is a reduction in face value. Have you understood this 222D very clearly? Yes or no? Okay. Now we'll move on to next clause. Next subclause is section 2 clause 22 subclause E. See, section 2, clause 22, subclause A, subclause B, subclause C, subclause D. In all these different subclauses, there were different approaches followed by the company to ensure that some benefit is given to the shareholder and dividend distribution tax payment is avoided. So government came out with different subclauses to tackle such situations. Now this year onwards there is no dividend distribution tax, but definitely we would levy tax on that amount in the hands of shareholders. So we need to definitely understand what we mean by deemed dividend. So now even if company distributes assets, on that also shareholder will have to pay the tax. Now we move on to section 2 clause 22 subclause E. But before we actually move on to section 2 clause 22 subclause E, here I am having a small distinction. Here I am having a small distinction. What is the difference between section 2 clause 22 subclause ABCD versus subclause E? What is the difference between section 2 clause 22 subclause ABCD versus subclause E? See, section 2 clause 22 subclause A, subclause B, subclause C and subclause D were applicable to all companies. They were applicable to all companies. Whereas section 2 clause 22 subclause E is applicable only to private company. It is applicable only to private company. Yes, is that very clear? This is the first distinction point. Before we actually enter section 2 clause 22 subclause E, let us be very clear as to how section 2 clause 22 subclause E is different as compared to section 2 clause 22 subclause A, B, C, D. So we have made a distinction. Yes or no? Are you understanding what I am trying to explain you? So before we enter section 2 clause 22 subclause E, I am explaining you what is the difference between the earlier 4 subclause and this one. Earlier 4 subclauses were applicable to all companies irrespective of whether the company was a private company or a public company, whereas section 2 clause 22 subclause E is applicable only and only to a private company. It is not applicable to a public company. This is the first point of distinction here. Second point, in section 2 clause 22 subclause A, subclause B, subclause C, subclause D, on the left hand side where total distribution was divided in 2 parts. Total distribution was divided in 2 parts. Now same balance sheet example, total distribution is 300. Left hand side we took how much? 80 rupees. Out of 300 left hand side we took 80 na. Distribution to the extent of accumulated profit whether capitalized or not. So for section 2 clause 22 subclause A, B, C and D, we used to take accumulated profit whether capitalized or not. Whether capitalized or not. Whether capitalized or not. But here in section 2 clause 22 subclause E, we have to take accumulated profits possessed by the company. Accumulated profits possessed by the company. What do you mean by accumulated profits possessed by the company? Accumulated profits possessed by the company means non-capitalized profit. Non-capitalized profit. Can you tell me from the balance sheet, the example which I took from that balance sheet, what is the amount of non-capitalized profit? Non-capitalized profit means that which is part of reserves and surplus. That is only 60. So now my bifurcation, if the total distribution is say, if the total distribution is 300, earlier I used to write 80 on the left hand side, 220 on the right hand side. Now if the total distribution is 300, I will not write 80 on the left hand side, I will write only 60 on the left hand side. And the balance 240, 300 minus 60, balance 240 will be written on the right hand side. Have you understood that clear distinction? Yes or no? Yes? Okay, now listen to me very carefully. Now actually we are entering into section 2 clause 22 subclause E. There is a private company. There is a private company. There is a registered and beneficial shareholder holding 10% or more shares in the company. See what private companies used to do now. Private companies, see, the objective of the company was to ensure that some benefit is given to shareholder, some assets of the company, they are given to the shareholder, and that too they were given without paying dividend distribution tax. Their intention was to give money to the shareholders but avoid the payment of dividend distribution tax. Therefore, they used to come out with different ideas. So if company gives some dividend to the shareholder, company was required to pay the dividend distribution tax. With an intent to avoid that payment of dividend distribution tax, few private companies came out with an idea. They transferred some money to their shareholders in the form of loan. In the form of loan. So company gave loan to the shareholder. Intention was to transfer the funds of the company to the shareholder, irrespective whether those funds are transferred in the name of dividend or whether those funds are transferred in the name of loan. Ultimately, shareholder is receiving money now. Ultimately, shareholder is receiving money. And company used to claim that this is not a dividend, this is a loan. And this would appear as a loan given to shareholder on the balance sheet asset side of the company. And this would appear as a loan taken from company in the balance sheet liability side of the shareholder. This loan will stand in their books of accounts forever. This loan will stand in their books of accounts forever. The intention was to transfer the funds of the company to the shareholder without payment of dividend distribution tax. So this private company started giving loan to the shareholders, saying that this is a loan, therefore on this dividend distribution tax cannot be levied. That was the stand taken by these private companies. Therefore, government was forced to come out with a separate clause to cover this. So, government came out with separate subclause, section 2 clause 22 subclause E. Now, government says, if a private company is giving loan, if private company is giving loan to the shareholder, which is shareholder? Shareholder holding 10% or more shares in the company. Shareholder holding 10% or more shares in the company. So he is a registered and beneficial shareholder having a substantial interest in the company. He is holding 10% or more shares in the company. In other words, he can easily influence the decisions of the company. He can easily influence the decisions of the company. So, such a shareholder who can easily influence the decision of the company was given a loan by the private company. That will be considered as deemed dividend as per the provisions of section 2 clause 22 subclause E part 1. Part 1 limb 1, we call it as limb 1. So, private company giving loan to the registered and beneficial shareholder will be considered as deemed dividend. To what extent it will be considered as deemed dividend, that we will discuss later. First of all, let us understand what things are considered as deemed dividend. Then we will understand to what extent they are considered as deemed dividend. So, right now I explained you one situation. A private company giving loan to the registered and beneficial shareholder holding 10% or more shares, that loan amount will be considered as deemed dividend as per section 2 clause 22 subclause E part number 1. Now point number 2, part 2. The moment the shareholders came to know that government has cashed us and government has made a provision for charging tax, they came out with a new idea. They said that do one thing, don't transfer the funds directly to us. You transfer funds to some other person and we will get that funds from that person. So, a new arrangement was created wherein company, this private company used to give loan to the HUF or the firm or any other association of person or body of individual or any other company. And in this company, the same shareholder was holding 20% or more shares. Same shareholder is holding 10% or more shares in the first company and is holding 20% or more shares in the second company. Now, first company is giving loan to the second company so that subsequently this amount will be transferred by the second company to the shareholder. So, shareholder is held in one company, in the first company is holding 10% shares, in the second company is holding 20% shares. So, he can easily influence the decisions of both the companies. So, he would ask the first company to give loan to second company and then he would take that funds from the second company. So as to remove the trace, if the funds are transferred by the first company directly to the shareholder, then there will be a trace now that funds are transferred from the bank account of the company to the bank account of the shareholder. But if the funds are transferred to some other person, then there would not be any direct tracing. So they came out with an idea to transfer the funds to HUF, firm, association, person, body of individual or any other company. And then those funds used to get transferred to the same shareholder. So government came out with second point, wherein government said that if a private company is giving loan to HUF, firm, AOP, BOI or a company, and in that company, that same shareholder is holding 20% or more shares, that will also be considered as deemed dividend. That will also be considered as deemed dividend. Have you understood second part? Yes or no? Yes? Now let's move on to third part. Second part also government caught this situation and government came out with an amendment to take this second part also within the purview of the deemed dividend. Now these very sharp people, very shrewd people, they came out with a different idea, saying that do one thing, if you pay us money directly, then they are considering it as deemed dividend. You pay us money indirectly through some other person, then also they are considering it as deemed dividend. Because whether I receive money directly or I receive money through other person indirectly, ultimately in my bank statement this amount is appearing. And since this amount is appearing in the bank statement, they can easily catch me. So these shrewd people came out with an idea to ensure that this amount of loan taken, this amounts taken from the company should not appear anywhere in the bank statement. If they do not appear in the bank statement, then it will be very difficult for the government to catch. So they came out with an idea saying that ask the company to pay the personal obligations of this shareholder. This shareholder, they were having the influence on the company because they were holding 10% or more shares. And private company, you know that what is the situation of private company. In case of private company, the directors are mostly family members only. So definitely they would have 100% control on the company. Family members would hold shares. So company started paying personal expenses of shareholder. So personal expenses of shareholder were paid by the company and those personal expenses were debited in the profit and loss account of company. For example, shareholders' electricity bill is paid by the company. So who will pay money to whom? Company will pay money to electricity company. In that case, in the bank statement of shareholder, that amount will not appear. Another transaction, for example, company paid school fees of shareholders' children. Who is paying money to whom? Company is paying money to school. That amount will not appear in the bank statement of shareholder. So company started paying the personal expenses of shareholder to ensure that this amount should not appear in the bank statement of shareholder. If these amounts are not appearing in the bank statement of shareholder, then successfully you have transferred some money to the shareholder only by paying his personal expenses. So he is not required to pay now. If he is not required to pay, that much amount he has saved. So they came out with this idea, and government came to know about this idea also over a period of time. See, all these sections, subclauses now, they are not developed at one go. They are not inserted in the Income Tax Act one go. Over a period of 10 to 15 years, slowly, a lot of things were inserted. And they have now become 5 different subclauses. In subclause E, you have 3 different parts. So don't think that all these things were inserted in the Income Tax Act at one go. All these things were inserted in the Income Tax Act over a period of time. See, please understand, this is a trial and error approach. This is a rectification approach. People fooled the government. Government came to know about that. To rectify those mistakes, government came out with an amendment. So over a period of time, this trial and error approach, rectification approach, government has developed so many provisions. That is the reason this deemed dividend provisions have now expanded a lot. So in third situation, we are saying that this private company in which this shareholder is a registered and beneficial shareholder holding 10% or more shares. This company is paying personal expense of this shareholder. This shareholder is having a personal transaction with the third party, and this personal expense of shareholder is paid by the company. Now Akash is asking me question, sir, now no DDT, everything is taxable in the hand of shareholder, then this section will not be used by the company. That is correct, but if at all such kind of distribution is done, you have to levy tax in the hand of shareholder also now. If you say that let us remove all these provisions relating to deemed dividend, what will happen? Then whatever company used to do, now same things, the same tricks, shareholder will apply now. Shareholder will say that money given by the company to us is a dividend. But if company is giving some other assets, then it should not be considered as dividend. So whatever trick companies used to apply, now same tricks the shareholder will apply. He will say that this is not dividend. I received loan from the company. I have received assets from the company. This should not be considered as dividend because dividend is money given to the shareholder. So same tricks the shareholder will apply. Therefore, these sections are still existing in the Income Tax Act. Only thing is, now instead of company paying dividend distribution tax, now the shareholder would be asked to pay the tax. That's all. But all these tricks would stay now. Akash, are you understanding? Yes or no? So we can't remove these provisions from the Income Tax Act. So part 3 says this private company has paid the personal expense of shareholder to the third party, and the shareholder has entered into a personal transaction with the third party. Now there is a transaction between this private company and the third party. Private company is paying some personal expense of shareholder to the third party. So this transaction, this payment would not appear in the bank statement of the shareholder. Now we have understood 3 situations. I have tried to explain you 3 situations in which the transaction will be covered by section 2 clause 22 subclause E. But now we need to also understand, to what extent it will be considered as deemed dividend. To what extent this distribution will be considered as deemed dividend, that is what we need to understand. So here once again similar type of flow chart you have. On the left hand side we have a private company, on the right hand side we have a registered and beneficial shareholder holding 10% or more shares. This private company has given loan advance to the shareholder, or this private company has given a loan or advance to a concern in which shareholder is having a substantial interest. So this is in point number A, I have covered part 1 as well as part 2. Point number B, I have covered part 3. Private company is paying personal expense of shareholder. Whatever is the amount incurred by this private company, take the total. Then you bifurcate that total in 2 parts, left hand side, right hand side. Left hand side will take what? Will take distribution to the extent of Accumulated profits possessed by the company. What do you mean by accumulated profits possessed by the company? Non-capitalized profit. In other words, capitalized profit should not be taken into account. In other words, capitalized profit should be excluded. It should be excluded. So left hand side I have written distribution to the extent of accumulated profits excluding capitalized profit. Excluding capitalized profit. So for example, 300 is given here. Left hand side, how much will take? We'll take 60 on the left hand side. How much will take on the right hand side? We'll take 240 on the right hand side. So on this amount appearing on the left hand side, shareholder has to pay tax under the IFOS. Amount appearing on the right hand side is a capital receipt in the hands of shareholder because this is over and above the reserve balance. This is over and above the reserve balance. So it is a capital receipt in the hands of shareholder and therefore it is not taxable. Why it is not taxable? Because the conditions of charging section are not fulfilled. Here shareholder is not transferring anything to the company. In section 2 clause 22 subclause C, there was liquidation. So shareholder was transferring the shares. In section 2 clause 22 subclause D, there was reduction in capital. So shareholder's shares of face value was getting reduced. But in section 2 clause 22 subclause A, subclause B and subclause E, shareholder is not giving anything to the company. So there is no transfer here, nothing is transferred. Therefore, distribution in excess of that accumulated profit amount appearing on the right hand side is a capital receipt for the shareholder. It is not taxable at all. It is not taxable at all. Have you understood this? Yes or no? Yes? We have covered up the entire concept of deemed dividend. How this deemed dividend is different? Or how the provisions are different as compared to last year? All provisions are same with two changes. Now company is not required to pay any dividend distribution tax. Instead of company paying the tax, now shareholder will be paying the tax, shareholder will not get any exemption. That's all. This is the only change. And we had one more section, section 115 BBDA. Those students who have already appeared for the examination in the month of November 20, they might be very much aware about all these dividend provisions. So for them, I wanted to tell you, section 1150 is deleted. So company will not pay dividend distribution tax. Section 10 clause 34 is deleted. Therefore, dividend will not be exempt in the hands of shareholder. It will be taxable in the hands of shareholder. One more, section 115 BBDA is also deleted. If you recollect, dividend in excess of 10 lakhs was also taxable in the hands of shareholder at the rate of 10%. That section is deleted. So section 1150, section 10 clause 34, section 115 BBDA, all these sections are deleted. So now this dividend is fully taxable in the hands of shareholder. Now I want to take you through section 57. Because here there is an amendment. And this is related to dividend income. Listen to me carefully. See, against a dividend income, that dividend income will be made taxable to the shareholder now. So you know that whatever expenditure is incurred for earning the income, those expenditure are always allowed as deduction. If you incur any expenditure for earning the income, if you incur any expenditure for collecting the income, those expenditure are incurred for earning the income. Those expenditures should be allowed to you as deduction. Up to last year, listen to me carefully. Up to last year, dividend received from domestic company was not taxable, but dividend received from foreign company was taxable. So, since dividend received from foreign company was taxable, whatever expenditure that shareholder might have incurred for earning that dividend, for collecting that dividend, was allowed as deduction from the dividend income. Now this year onwards, dividend received from domestic companies also taxable. So this year onwards, dividend received from foreign company as well as domestic company, both are taxable. So from this dividend income, generally we would give you deduction with respect to any expenditure incurred for earning that dividend income and collecting that dividend income. But now government has restricted the deduction. Government has restricted the deduction. See this point, section 57, clause number 1, actually this is applicable for dividend income as well as interest on securities. But we have not yet discussed interest on securities. Therefore, you just focus on dividend part. From the dividend income or interest on securities, dividend as well as interest on securities are definitely now taxable. But whatever expenditure you might have incurred, that can be claimed as deduction. The question is which expenditure can be claimed as deduction. So this section 57 clause 7 clause 1 says any reasonable sum paid by way of commission or remuneration to a banker or any other person for the purpose of realizing the dividend or interest income. What do you mean by reasonable sum paid to banker or any other person for the purpose of realizing the dividend or interest income? It is nothing but collection charges. In your accountancy in 11th standard, you might have learned collection charges. You pay collection charges to the bank for collecting the dividend and interest income on your behalf and crediting your bank account. That collection charges can be claimed as deduction. Besides, if you have taken loan for investing money in shares or debentures, that interest paid on that loan can also be claimed as deduction. See, if any person is taking loan and he is investing into shares, to a greater extent he is mentally disturbed person, because he has taken loan, so he has to pay fixed rate of interest, and he has invested money in shares. So in shares, every year he may not receive dividend. So no individual, no person would take the loan to invest money in shares. But it may happen that you might have taken loan of 10 lakhs and you have invested 10 crores. 9 crore 90 lakhs you were having with you. 10 lakhs you took the loan and you acquired the shares for 10 crores. That can happen. In that case, whatever interest you are paying for what? On that borrowing, that interest can be claimed as deduction. For that, government has come out with an amendment in the form of restriction. And in amendment they have inserted a restriction. They have put a restriction saying that we will not allow you deduction for interest for the entire amount. We will allow you deduction for interest only to the extent of 20% of your dividend income. Only to the extent of 20% of your dividend or interest income. So it says what? Only expenditure of interest restricted to maximum of 20% of dividend income or income from units shall be allowed to be deducted from such income. No other deduction will be allowed. See, in other words, from the dividend income, you cannot claim deduction for collection charges. You cannot claim deduction for any other expense. Only one deduction will be allowed. Only one. What do you mean by only? Only this expenditure will be allowed as deduction. What is this expenditure? Interest on loan which you might have taken for investing in shares. That interest on loan will be allowed as deduction. That too restricted to 20% of dividend income. Restricted to 20% of dividend income. Have you understood? Yes, have you understood the proviso inserted in section 57 clause 1? Or you want me to take an example? Understood, not understood? Example, okay. Let me take the number. Say for example, your dividend income is 50,000 rupees. The dividend income is 50,000. You have taken a loan for investing money in shares. Loan amount is 3 lakhs. This loan was taken at the rate of 10 percentage. So can you tell me what is the interest? Interest on loan is 30,000. Yes or no? But we are not going to give you deduction for 30,000. Your deduction will be restricted to 20% of your income. What is 20% of your income? 20% of 50,000. What is the amount of 20% of 50,000? 10,000. So your actual interest on loan expenditure is 30,000, but we are going to give you deduction only for 10,000. So your dividend income which would be taxed is 40,000. 40,000 will be taxable to you under the income from other sources. Have you understood this provision very clearly? Yes or no? Yes. So let us move back to that textbook page. That section 57 clause 1 is over. So point number 1 is over. Let me mark one more point. Point number 4 is also over. If you remember family pension, standard deduction na 33 1/3% or 15,000 whichever is lower was allowed as standard deduction. This is also over. Then point number 6 is also over if you recollect. This was already covered in the chapter of capital gains also. Today also I have revised. Interest on initial compensation, enhanced compensation, 50% standard deduction will be allowed. So these points I am covering with respective topics. Instead of covering section 57 separately, I am covering with the respective topics so that logically you will understand the points. So with this, our discussion with respect to interest income comes to an end. Now we move on to second point, that is winnings and casual income. Winnings and casual income. Here we are saying that winning from lotteries, winning from crossword puzzle, winning from races including horse race, winning from card games, and other games of any sort, See, other games of any sort will include Kaun Banega Karodpati. I do not know whether you are aware or not. Very popular game show, Kaun Banega Karodpati, hosted by Amitabh Bachchan. So that is a other game of any sort. From that, if you win something, that amount will become taxable. Or you have won money in gambling or betting of any form or nature whatsoever. Gambling or betting. See, betting in cricket matches is illegal in India. It is not allowed. Betting money in a horse race is legal, but betting money in cricket match is illegal. But still you betted money. You were caught. Will it be taxed? Whether your winnings from that betting will be taxed? Yes, because the income tax will be taxed on legal income as well as illegal income. If betting in cricket match is illegal, then the law in which it is illegal, as per that law, action will be taken against you. Income tax department's job is to just collect the income tax. So even if your income is illegal, they would come to you, they will collect the income tax, that's all. Then they will definitely give tip to that other department who is responsible for this. So winning from lotteries, crossword puzzle, races including horse race, card games or any other game of any sort, gambling, betting, all these things are taxable under the income from other sources. Here only for a reference I have given you meaning of lottery, what do you mean by lottery, what do you mean by card games and other games of any sort. Now the point is, this is taxable at what rate, this is taxable as per which section, what are the important provisions related to taxability of this. So all these winnings and casual income, they are taxable as per the provisions of section 115BB. Important point number 1 here says tax rate is flat rate 30% plus education cess plus health and education cess. Here I have by mistake written plus education cess plus secondary and higher education cess. You do one thing, you remove these words, you delete this and you write health and education cess. Health and education cess at what rate? 4%. 4%. So all these winnings, etc., winning from lottery, crossword puzzle, card games, gambling, betting, these winnings are taxable at 30%. Tax rate is flat rate 30%. You cannot claim deduction for any expense. You cannot claim deduction for any expense. Say for example, in Kaun Banega Crorepati, you have won 1 crore rupees and you are claiming that I have not won, actually I had prepared for this. For that I had taken the tuition for history, geography, mythology, science. For learning all these things, I took the tuitions and I paid the tuition fees to different teachers. Then I prepared rigorously for entering into this Kaun Banega Crorepati and I knew that I will win at least 1 crore because I was very much prepared for that. So from this 1 crore of income, 1 crore of winning, you give me deduction for the tuition fees which I paid to the teachers. Government says don't claim any deduction. Deduction will not be allowed for any expenses. Losses cannot be set off against this winning. So if you are having losses under income from house property, business, profession, etc., you cannot set off the loss against such winnings. Chapter 6A deduction cannot be claimed against such winnings. This I have already explained you in the chapter of capital gain while discussing tax rates, saying that chapter 6A deduction cannot be claimed against any income which is taxable at fixed rate. Chapter 6A deduction cannot be claimed against long-term capital gain covered by section 112. It cannot be claimed against long-term capital gain covered by section 112A. It cannot be claimed against short-term capital gain covered by section 111A. It cannot be claimed against winnings which is covered by section 115BB. Let's move on to the last point. Adjustment of unexhausted basic exemption limit is also not permitted against such winnings. Do you understand the unexhausted basic exemption limit I have discussed with you? If your income taxable at slab rate after chapter 6 deduction is less than the basic exemption limit, then there would be an unexhausted basic exemption limit. That unexhausted basic exemption limit, how will you derive the amount? Basic exemption limit minus income taxable at slab rate after chapter 6A deduction. Difference would be unexhausted basic exemption limit. That unexhausted basic exemption limit you can adjust against LTCG covered by 112, LTCG covered by 112A and STCG covered by 111A, but you cannot adjust against winnings. On winnings you have to pay the tax, that's all. Don't claim deduction for any expense, no set off of loss, no chapter 6 deduction, no adjustment of unexhausted basic exemption limit. Winning is a casual income for you, unexpected income for you. So government also wants unexpected tax. At what rate? 30%. 30%. Let's move on to last 3 small points with respect to this. And once those 3 small points are over, this winning will also come to an end. Listen to me carefully. This we will definitely cover. This will once again will cover in the chapter of TDS. But I am just telling you as a passing reference that in the chapter of TDS there are two sections, and those are section 194B and section 194BB. Those are section 194B and section 194BB. If you are having any winning from lottery, crossword puzzle, card games or any other sort of gambling etc., then TDS will be deducted at that of 30% if the amount of winning is more than 10,000. If the amount of winning is more than 10,000, TDS will be deducted at 30%. See here the amount of tax is 30% and the rate of TDS is also 30%. Generally the rate of TDS is 10%. Generally the rate of TDS is 10%, but in case of this income the rate of TDS is 30%. So tax rate and TDS rate both are different, but in this case the tax rates and TDS rate both are same, 30%. 194BB they have segregated winning from horse race. On this also, if the amount of winning is more than 10,000, 30% TDS will be deducted. 30% TDS will be deducted. Now before I move on to next point, I want to just ask you a very simple question from the chapter of income from salary. And the question is, what is taxable? Gross basic salary is taxable or net basic salary is taxable? What is taxable? Gross basic salary is taxable or net basic salary is taxable? Definitely gross basic salary is taxable. What if examiner has just given you the amount of net basic salary, he has not given you the amount of gross basic salary? What you will do about it? To that net basic salary, you will add all the deductions which are made. You will add back all the deductions to get the amount of gross basic salary. Similarly, if I tell you that you have got the winnings of 7 lakhs, you have got the winnings of 7 lakhs and these are after deducting 30% TDS. You have received the winnings of 7 lakh after deducting 30% TDS. So this is net amount now. This is net of TDS amount. Net of TDS. In that case, can you tell me what will be the gross amount? This is the net of TDS amount 7 lakh. What will be the gross amount? If you want to calculate the gross amount, if you have won 100 rupees, they would deduct TDS at rate of 30% on that 100. That will be 30 rupees. So from 100, if you deduct 30, what you would receive is 70. So this 7 lakh is 70%. So what is the gross amount? 100% would be 10 lakhs. This would be the gross amount. Now the question is, if the examiner has given you net amount in the question, should you consider the gross amount in income or should you consider the net amount in income? Definitely you should consider the gross amount in the income. Definitely you should consider the gross amount in the income. So if examiner has given you the net amount in the income, then you can apply this formula and ascertain the gross amount. You can apply this formula and ascertain the gross amount. Is that very clear? Yes or no? Point number 3. Before I actually explain this, point number 3, that is section 56 subsection 2 clause 1c, I would try to revise one point of the chapter of PCVP and you should try to recollect that point. If you are successfully able to recollect that point, then there is no need to explain this point number 3. I will explain, but slightly faster. In the chapter of PGBP, I had explained to that in case of a provident fund, employer, employee both will contribute. Deva is asking me question, sir, first TDS is deducted. Thereafter, once again 30% is taxed. Yes, that is correct. But that will not amount to double taxation. Why not? From your final tax liability, we will allow you to deduct the amount of TDS now. From the amount of final tax liability, TDS will be deducted and you will be asked to pay only the balance amount of tax. So what will be included in your gross, in your income is gross amount, that is 10 lakhs. You take 10 lakhs in your income, you calculate your gross total income, you take chapter 6 deduction, calculate your taxable income, on that you calculate the tax liability, from that tax liability you deduct the amount of TDS, that is 3 lakhs. Deva, have you understood? So with this, our dividend point is over. Point number 1, dividend is over. Point number 2, winning is also over. And 3 points were already over. So out of 12 points, how many points are over? 7 points are over. Sorry, 5 points are over. Out of 12 points, 5 points are over. I have given you the list of those points on this page, page number 239. There are 12 points. Out of these 12 points, 3 points were already covered. One was covered in IFHP, 2 were covered in capital gain. Right now I have covered dividend income. I have also covered winning from lotteries, etc. See, all these are small points. What is the big chunk now? Dividend income was important. But because of removing that DDT, etc., now it has become comparatively simpler. But still, deemed a dividend, you have to refer properly day before examination. And the second part which is important in this chapter is gift provisions. Second part which is important in this chapter is gift provisions. So I have covered point number 1, point number 2. Do one thing. I will not refer point number 3, point number 4 and point number 5 right now. Point number 3, 4, 5, 7 and 8. Point number 3, 4, 5, 7, 8. I would give these 5 points to you as homework. Definitely I would discuss in a very much detail. But if beforehand you have studied now, it would be simpler for you to understand. And for me also it will be a time saving exercise. So do one thing. As of today now, I am skipping some point. I am giving you those as homework. You can refer that at home and then we can discuss. It would consume less time and you will also have a better understanding of the provisions. So which points I am giving you as homework? Point number 3. Homework means you have to read it and try to understand. Point number 3, 4, 5, 7 and 8. 3, 4, 5, 7, 8. These 5 points I am skipping right now. We'll try to cover up tomorrow morning. Take this as part of homework today. Read it. You may understand, you may not understand. Around 60-70% of the things you will understand. Remaining 20-30% of the things you may not understand. Don't worry about that. I will cover properly in the class. But if you read beforehand, then less time will be consumed in the class and you can ask the quality doubts. If you have read beforehand, you will understand in a much better manner and you will ask a quality doubt. Now I am moving on to point number 11 and 12. These 5 points I have skipped right now. I am moving on to point number 11 and 12. 12 is very simple point, very small point, inserted in the Income Tax Act just before 2 years. Why it is inserted in the Income Tax Act under the head income from other sources is not known to anyone. Actually, this point was not required at all. If I read this, You can easily recollect that this point is covered somewhere. So I'll read this point, point number 12. You tell me where I have covered this point. Point number 12 says compensation or any other payment received in connection with termination of employment. Termination of employment. Where we did cover this point? Sarvana has already given me the answer. We have covered this in the chapter of income from salary. Deva says we have also covered in PGBP. Madam, PGBP na we covered compensation in connection with termination or modification of terms of agency contract. Terms of agency contract or nationalization of business or any other business contract. But this is termination, compensation received for termination of a employment contract. Employment contract means there is a employer-employee relationship. And I strongly believe that by mistake government has come out with such amendment because there was such point already existing in the chapter of income from salary. In section 17 subsection 3 we already have this point, and if at all amendment was required, why in IFOS? Why in IFOS? If there is an employer-employee relationship, everything should be taxed under income from salary only. Tax should not be levied under income from other sources. So I have spoken to a lot of experts in the field of income tax. We all have the same opinion saying that by mistake government has inserted this point in IFOS. In fact, there was no need of such point in IFOS because we already have such point in salary chapter as well as PGBP chapter. So this point number 12 is over. Now we move on to the most important aspect, most important concept, most important part of this chapter, that is provisions relating to gift. The word gift is not used in the Income Tax Act. In the Income Tax Act, they have not used the word gift. They have used the word something received without consideration. Anything received without consideration. So instead of using the word gift, they are using the word anything received without consideration. So if anything is received without consideration, or it is received by paying consideration, but the consideration is inadequate, then taxability would arise under the IFOS. See, your gift provision now, they are starting on page number 249. Then you have page number 250. Then you also have page number 251 and some part in page number 252, this much. This many pages I have summarized for you in the form of flowchart. So this Rangoli type flowchart I am having here. One flowchart, second flowchart, and the bigger one, third flowchart. With the help of this flowchart, you can revise the provisions relating to gift and something acquired for inadequate consideration day before examination in maximum 10-15 minutes, maximum. So let us try to cover up this. Let's start with this small flowchart. Gift. Let me divide this in two parts. When gifts are taxable, under which head they are taxable. And number two, when they are not taxable. Instead of using the word exempt, we should use the word when they are not taxable. So first of all, I am on the left hand side, first box, gift received from employer. Gift received from employer. This we have already discussed in the chapter of income from salaries. Gift received from employer was divided in two parts. Gift received in cash is fully taxable. Gift received in kind. If the aggregate amount of gift is less than equal to 5,000, it is totally exempt from tax. If the aggregate amount of gift, which gift? Kind gift, aggregate amount is more than 5,000, then I told you that there are two opinions. Opinion 1, Amount in excess of 5,000 is taxable. And opinion 2, entire amount is taxable. Do you recollect that? Section 17, subsection 2, clause 8, fringe benefit as may be prescribed. We had 8 points. Yes, we had 8 points. Point 1, interest-free loan, concessional loan. Point 2, traveling accommodation, touring, other expenses. Point 3, free meal and refreshment. And point 4 was gift. So this we have already discussed in section 17, subsection 2, clause number 8. This is taxable under that income from other sources. Let's move on to second point. Point number 2. Benefits or perquisites arising out of business or profession. Benefits or perquisites arising out of business or profession. What do you mean by benefits or perquisite arising out of business profession? If you are either into business or you are into profession, whatever benefit you receive will become taxable. I have already explained you this in the chapter of PGVP, saying that all the cricketers, playing cricket is a profession for them. So if the cricketers are receiving man of the match award, man of the series award, all those awards, monetary awards as well as non-monetary. Say for example, cricketer has received a man of the series award. He has received a Volkswagen Vento car. The value of that car will become taxable to him. I also give an example in the chapter of PGP, saying that, say for example, a doctor has performed a surgery successfully on a patient. Patient is very happy that because he is properly cured. So he has given fees to the doctor and he has also gifted a car to the doctor. That car received by the doctor from the patient is for appreciation of his medical services. That is taxable under that PGVP. Under that PGVP, cash is taxable, kind is also taxable, everything is taxable. Everything is taxable. There is no limit also. Even 100 rupee benefit you receive now, that will also become taxable. Yes? Do you remember? This is taxable under section 28, under that profits and gains of business or profession. Let's move on to the last part and let's move on to the chapter of income from other sources. If you have received gift from any other person, if you have received gift from any other person means you have not received gift from your employer. Also, your gift which is received is not in connection with business or profession. In that case, it can be taxed under section 56, subsection 2. See this clause number 7, this is wrong. Wrongly it is typed. It was an old clause, now you can remove these. Instead of that, you can write clause number 10. Clause number 10. So instead of clause number 7, now it is clause number 10. Shall I proceed? Gift received from any other person can be taxed under income from other sources in section 56, subsection 1, clause 10, if it is not covered by exemption. If it is not covered by exemption. Exemptions are given on the right hand side, on the right hand side. So first of all, let's move on to the right hand side. Let's understand which are the gifts which are not taxable. If your gift is covered by this list, no tax. If it is not covered by that list, it will automatically become taxable. Number 1, gift received from relative is not taxable. Gift received from relative is not taxable. Irrespective of amount, whether the gift value is 50,000, 5 lakh, 50 lakh, 5 crores, 50 crores, 5,000 crores, whatever it may be, it is not taxable at all. Gift received from relative is not taxable. Now you may ask a question, what do you mean by relative? So we have a small flow chart here to explain you what do you mean by relative. Who all are covered by the term relative? Relative in relation to individual will include following. Relative in relation to individual includes following. Say for example, here we have individual. This individual is, say for example, Mr. Manoj. Mr. Manoj. This individual is Mr. Manoj. So, for Manoj, who all will be considered as relative? That is what we need to understand, because Sarvana is asking me, sir, 40 capital is subsection 2 relative definition, and this relative definition, are they same? Answer is no, they are not same, they are different. This definition is much wider in scope. Relative definition, it is appearing in different sections in the Income Tax Act. So we have different relative definition. For section 40 capital subsection 2, we have a different definition. For IFOS chapter, we have a different definition. And for clubbing chapter also, we have a different definition. So say for example, here we have an individual Mr. Manoj. Who all will be considered as relative for Mr. Manoj? That is what we need to understand. Because whatever gift he receives from this relative, that gift will not be taxed. So number one, for Mr. Manoj, his spouse is a relative. Means Mrs. Manoj is a relative. That is point number one. Point number one. Point number two, brother or sister of Manoj. Not all brother, cousin, sister, I am not talking about them. I am talking about the real brother and real sister. Brother and sister of Manoj. They are considered as relative for Manoj. So any gift received by Manoj from his brother, from his sister would not be taxed, because it is a gift received from a relative. Number three, brother and sister of spouse of individual. So these are brother and sister of Mrs. Manoj. Generally, Manoj would not receive gift from someone. Gift from this brother and sister or spouse. He will force them to give him gift. So brother and sister of Mrs. Manoj would be considered as a relative for Mr. Manoj. This is point number three. This is point number three. Now listen to me carefully. Point number four. Brother and sister of father of Manoj. Brother and sister of father of Manoj and brother and sister of mother of Manoj. Do you understand? Brother of father? Yes or no? See, English is a very ambiguous language. English is a very ambiguous language. Everyone is called as uncle. We call everyone as uncle only. So whether it is father's brother or it is mother's brother, everyone is uncle for us. But local language now we use different terms. Mother's brother we call it as mama. I do not know what you call it as in Tamil, what you call it as. You do not know. But in Hindi we say mother's brother is mama. Father's brother is either chacha or kaka. So different words are used. But in English, everyone is uncle only. So this is a, yes, so you may, yes, you may have different words. I do not know Tamil entirely. Chittappa. So number one, for Mr. Manoj, Mrs. Manoj is a relative. Number two, for Mr. Manoj, his own real brother and real sister are relative. Number three, for Mr. Manoj, brother and sister of Mrs. Manoj are relative. Number four, for Mr. Manoj, his father's brother and sister, they are relative. For Mr. Manoj, his father's brother and father's sister, they are relative. For Mr. Manoj, his mother's brother and mother's sister, they are also relative. See, mother's brother is mama. Mother's sister, don't tell it is mommy. Mother's sister is Masi it is called as. So, we have 4 persons here. This is father's brother. This is father's sister. Chitti in Tamil, yes. So, this is father's brother, father's sister. This is mother's brother, and this one is mother's sister. These 4 people are considered as relative for Mr. Manoj in point number 4. Then we have point number 5. Point number 5, lineal ascendant of individual and lineal descendant of individual. Lineal ascendant of individual means those people because of whom you are there in this world. And lineal descendant means those people who are there in this world because of you. So for you, lineal ascendant means your father. Lineal ascendant means your grandfather. Lineal ascendant means your father of grandfather, previous generations. Lineal ascendant. And lineal descendant means those people who are there in this world because of you. That is your son, your daughter. So the previous generation and next generation. But listen to me very carefully. We cannot use these words in a layman language. Linear ascendant, na? I cannot use the word previous generation, next generation. Why na? Linear ascendant will not include mother. You might be shocked to know this, but yes, this is the fact. Lineal ascendant word will not include mother. Will not include your grandfather's wife. That is your grandmother. Grandmother will not be included in this linear ascendant word. Your mother will not be included in linear ascendant word. Linear ascendant means only males. Only males. But yes, in linear descendant you are having male, female both. Means in linear descendant word, son, daughter both are covered. In linear descendant word, son as well as daughter both are covered. But in linear ascendant, only father is covered, mother is not covered. Have you understood this very clearly? Yes or no? Yes? So lineal ascendant word will not include mother or grandmother. So this is point number 5. Lineal ascendant of Manoj and lineal descendant of Manoj. Next is point number 6. Point number 6 is lineal ascendant of spouse of Manoj and lineal descendant of spouse of Manoj. See, lineal ascendant of spouse of Manoj will be different, but lineal descendant would remain the same, na? Yes or no? So, lineal ascendant of spouse of Manoj means Mrs. Manoj's father, Mrs. Manoj's grandfather. And linear descendant means son and daughter only. Common, son and daughter will be common, na? Linear descendant would remain the same. This is written in point number 6. And last is point number 7. Point number 7 says, spouses of all those people who are covered from point number 2 to point number 6. Spouses of all those people who are covered from point number 2 to point number 6. Why they have not covered point number 1? In point number 1 it is spouse of individual. That is for Manoj. Point number 1, spouse is Mrs. Manoj. And Mrs. Manoj's spouse is Manoj himself. So he is not going to give gift to himself now. Therefore, point number 7 says spouses of the persons covered by point number 2 to point number 6. Covered by point number 2 to point number 6. See, now tell me who was covered by point 2? Point 2, Manoj's brother and Manoj's sister. They were covered by point 2. So point 7 says Manoj's brother's wife and Manoj's sister's husband. They are relative. It also says Manoj's wife, brother's wife and Manoj's wife, sister's husband. They are also relative. Next, these were covered in point number 2 and 3 respectively. Deva, I am coming to that point only. I am coming to your point. So I am repeating, listen to me very carefully. Point number 2 to point number 6 now. Those people who are covered by point number 2 to point 6, spouses of those persons. Spouses of those persons. Who were covered by point number 2? Brother and sister of Manoj. So brother's a spouse. Manoj's brother's a spouse. Manoj's sister's husband. They are relative for Manoj. Who all were covered by point number 3? Mrs. Manoj's brother was covered by point 3. Now, Mrs. Manoj's brother's wife and Mrs. Manoj's sister's husband, they will be considered as relative. They are covered in point 7, but Mrs. Manoj's brother and sister, they were covered in point 3. Point 4, who all were covered by point 4? Manoj's father's brother, father's sister, and Manoj's mother's brother and mother's sister. They were covered by point number 4. So their spouses, see Manoj's father's brother, spouse, Manoj's father's sister, na? So sister's husband, Manoj's mother's brother, mama. So this spouse is mommy. Manoj's mother's sister, we call it as Masi in Hindi. So this is Masa. Do you understand now? Yes or no? Hey, are you understanding? See, every family tree, it is entire family tree. Generation tree, family tree, whatever you call it as. Point number 5. Point number 5, lineal ascendant and lineal descendant of individual. But I told you that lineal ascendant will include only the male members. So now comes the female spouses. So mother will be covered by point 7. Father will be covered by point 5. Lineal ascendant of individual. Mother will be covered by point 7. Spouse of lineal ascendant. So mother is covered by point 7. Grandmother is covered by point 7. Yes. If you have lineal descendant, you have son, then son's wife, daughter-in-law will be covered by point 7. If you have a daughter, then her husband, that is your son-in-law, will be covered by point 7. Yes. Point number 6. Who all were covered by point number 6? Lineal ascendant and lineal descendant of spouse of individual. Means Mrs. Manoj's lineal ascendant and lineal descendant. So Mrs. Manoj's father was covered in point 6. Now Mrs. Manoj's mother will be covered by point 7. Mrs. Manoj's grandfather was covered by point 6. Mrs. Manoj's grandmother will be covered by point 7. Mrs. Manoj's lineal descendant and Mr. Manoj's lineal descendant would remain the same. So their spouses are also covered. Have you understood this definition of relative? Yes or no? Yes. Now listen to me very carefully. I would ask you a question. If you if you receive gift from relative, it is not taxable. If you receive gift from someone else who is not covered by this diagram of relative, then it is taxable. For example, now I would ask you question, you should answer me. For example, Mr. Manoj received gift from Mr. Manoj. Mr. Manoj received gift from Mrs. Manoj. Taxable or not taxable? If it is taxable, you should type C. If it is not taxable, you should type NT. If it is taxable, you should type T. If it is taxable, you should just type T. And if it is not taxable, you should type NT. That's all. So, Mr. Manoj has received gift from Mrs. Manoj. What is the answer? Not taxable. Okay. Mr. Manoj has received gift from his father. Wife's father. Mr. Manoj has received gift from wife's father. He has received gift from his grandfather. Manoj has received gift from his grandfather. In that case, we should ask a question: which grandfather? Paternal grandfather or maternal grandfather? See, very important point. If Manoj is receiving gift from paternal grandfather, then they are covered by the term relative. Paternal grandfather, paternal grandmother, they are covered by relative. But maternal grandfather, maternal grandmother, the mother's father, mother's mother, they are not covered by relative. The father's father and father's mother, they are covered by relative. So if Mr. Manoj is receiving gift from mother's father, mother's mother, that is maternal grandparents, they are not covered by relative. If Manoj is receiving gift from them, then what will happen? Then it will become taxable. To save the tax, what should be done? You should ask your maternal grandparents to give gift to your mother, and then you should take gift from your mother. Because for you, your mother is a relative, and for your mother, her parents are relative, no? Are you understanding? Yes or no? Are you getting my voice? Are you all connected or not connected? Yes, okay. So I'm giving you some important points. Such points are asked in the examination. And most of the students would give the wrong answer, because generally these people are relative. In practical life, we believe that they are relative. But you go by the definition of relative, they are not considered as a relative. So your maternal grandparents, you are considering them as relative, but Income Tax Act is not considering them as your relative. So if you receive gift from them and you don't apply the provision of Income Tax Act, you will say that no, they are my relative. But as per Income Tax Act, they are not. So gift received from a person who is not a relative is taxable. So examiner will intentionally give you such points only. So you need to remember these points. Day before exam, you need to revise this. Otherwise, you are gone. Number one. Gift received from maternal grandfather, maternal grandmother is fully taxable. They are not relative. Gift received from your cousins, cousin brother, cousin sister, they are not called by definition of relative. Son and daughter of your brother, son and daughter of your brother, son and daughter of your sister, son and daughter of your father's brother, son and daughter of your father's sister, son and daughter. See, anyone's son and daughter is not covered in this diagram. Anyone's son and daughter is not covered by this diagram except your son and daughter. That's all. Only your son and daughter are covered by this diagram. Anyone else's son and daughter, they are not covered by this diagram. So examiner would try to give you all these things. So you should be very much alert. These 7 points you have to remember, 7 points. So in relation to individual, these 7, those people who are covered by these 7 points, they are considered as relative. Anyone else is not considered as a relative. If you receive gift from relative, it is not taxable. If you receive gift from non-relative, it is taxable if it is exceeding 50,000 rupees. That we'll discuss later. Now we are in the definition of relative. Here we are saying that for an HUF, any member of family is relative. For HUF, any member of family is a relative. Now listen to me very carefully. Here we have two things. I am giving an example, Mr. Manoj. And we have Manoj HUF. We have Mr. Manoj and we have Manoj HUF. Mr. Manoj is part of Manoj HUF, na? He is Karta. So very important point, listen to me carefully. For Manoj HUF, Manoj is a relative because he is the member of HUF. For Manoj HUF, Manoj is a relative because he is a member of HUF. But for Manoj, his HUF is not relative because in relation to individual, only 7 points are, those who are covered by 7 points, they are relatives. In those 7 points, you did not see HUF. So, see the law, see the loophole in the law. For HUF, Manoj is a relative, but for Manoj, his own HUF is not a relative. So, if HUF is receiving gift from Manoj, it is not taxable. But if Manoj is receiving gift from HUF, it will be taxable because Manoj has received from non-relative. Such kind of situation had arisen in the Gujarat. Such kind of situation had arisen in case of one SSE in Gujarat, and the case reached up to the level of Gujarat High Court. And Gujarat High Court explained that HUF is not a natural person, HUF is an artificial person. So if you look behind the HUF, you are having different members. Say for example, here you are having Mr. Manoj, here you are having Mr. Manoj, Mrs. Manoj, Manoj's son number 1, son number 2, Manoj's father, Manoj's mother. So Gujarat High Court gave the decision, if Manoj is receiving gift from HUF, as per law, for Manoj his HUF is not relative. But HUF is an artificial person. So don't look at this artificial person. When Manoj is receiving gift, it is as good as he is receiving gift from this group of individuals. And every individual in that group is a relative for Manoj. Therefore, as per the Gujarat High Court judgment, gift received by Manoj from his HUF also should not be taxed because for Mr. Manoj, it is considered as a relative. This was the decision given by the Gujarat High Court. No amendment has been made in the Income Tax Act. So definitely this is applicable to the state of Gujarat. What about others? We don't have such law. So I have tried to explain a very important point. Generally this is covered at CA final, not at CA intermediate. So here we have covered the definition of relative. So we were going through the Gifts which are not taxable. So number one, if you receive gift from relative, it is not taxable. Number two, gifts received on the occasion of marriage is not taxable. Gift received on the occasion of marriage of individual is not taxable. So for example, Manoj is getting married today. If Manoj is getting married today, if you are giving him gift because of marriage, it is not taxable at all. But very important point to be noted is gift received on the occasion of marriage anniversary is taxable. And gift received on the occasion of marriage is not taxable, but gift received on the occasion of marriage anniversary is taxable. Why not? If gift received on the occasion of marriage anniversary they are not taxable, then marriage anniversary will come every year. So throughout the life, whenever he receives gift, he says that this is because of marriage anniversary. So government says gift received on the occasion of marriage is not taxable, but gift received on the occasion of marriage anniversary is taxable. See, such kind of question will be asked to you in the examination. Gift received on marriage anniversary, those are taxable. Gift received on occasion of marriage, not taxable. Gift received on the occasion of marriage anniversary, taxable. Gift received on the occasion of birthday, taxable. Now listen to me very carefully. They are not using the word gift received on the day of marriage are not taxable. No, they have not used the word gift received on the day of marriage is not taxable. They have used the words gift received on the occasion of marriage is not taxable. Means, for example, Manoj had invited me in his marriage, but because of some reason I could not attend his marriage. I have a huge regret. I lost a chance to have free food. I could not attend his marriage, so I lost a chance of having good food now. But later on, I met Manoj personally and I told him, sorry, I could not attend your marriage. But definitely, if I would have come to your marriage, I would have gifted you something. So I am giving you gift right now. Manoj's marriage is over. Honeymoon is also over. Everything is over. After 6 months, I met Manoj and I have gifted him 11,111 rupees by check. Will it be taxable or it will not be taxable? For example, it is not 11,000. Let me tell you, it is 51,000. I could not attend Manoj's marriage. After 6 months, I met him. I gifted him 51,000 by check. Taxable or not taxable? You may say that it is taxable, but it is not. Why? Because the reason of giving the gift was marriage. That is the reason I told you, they are not using the word gift received on the day of marriage. They are using the word gift received on the occasion of marriage. Means, if the reason behind giving the gift is marriage, then no tax. Whether you give gift on the day of marriage or you give gift after the day of marriage. The reason, the proximate reason for giving the gift should be marriage, then no tax. Therefore, the year in which you are getting married now, throughout that year, whenever you receive the gift, you can say that yes, I have received because of marriage. And in that case, nothing will be taxed. But that is only up to first marriage anniversary. Only up to first marriage anniversary, you can receive gift because of marriage. Then after, if you receive, then definitely it is marriage anniversary gift and that will become fully taxable. See, prior to marriage also, say for example, Manoj has invited me in his marriage. Manoj is getting married after 1 month. But I am a non-resident person. I am residing in USA. I came to India. Manoj invited me. So the day I am living in India, I am saying sorry to Manoj. I cannot attend your marriage because I need to go to USA now. Already my tickets are booked. So sorry for that. I would not be in a position to attend your marriage. I gave him 51,000 as gift. What is the purpose of gift? Purpose of gift is he getting married. So that will also not become taxable. Even if the gift is given before the date of marriage, that also not taxable. Rizwan says, sir, he is getting married second time. Then what? Then also no tax. But he can't say that I will divorce the same wife, I am getting married to the same wife. No, no. Otherwise, every year person will claim, na, at the beginning of the year, first day, he had given the divorce, and second day he will say, I have got married to the same girl. That is not allowed. Otherwise, throughout the life, he will divorce and he will get married to the same girl once again. See, why the gift provisions were issued, were inserted in the Income Tax Act now? People were converting their black money into white money. Long back, long back, we had something called as gift tax. There was a gift tax act. There was a gift tax act in India. That gift tax act was scrapped in the year 1998. Thereafter, it was reintroduced in the year 2002. Once again, it was scrapped in the year 2005. Gift tax, when there was gift tax act, tax was levied to the person who was giving the gift. Gift tax act was scrapped. Thereafter, people started converting their black money into white. For example, you are having 10 crores black money and I am having 10 crores white money. White money means I have paid tax on that. That amount is lying in my bank account. Black money means you have not paid any tax on that. So that is lying with you in the form of cash. So I will give you a gift of say 10 crore and you will give me 11 crore cash. So I am gifting you 10 crores and I am getting 11 crores in cash from you. That 1 crore you have given me extra for helping you to convert your black money into white. After the scrapping of gift tax, this conversion of black money into white money started. That is the reason government was forced to come out with the gift provisions in the Income Tax Act. The gift provisions were introduced in the Income Tax Act only in the year 2005. Before 2005, we did not have any tax on gift in the Income Tax Act. So, that is the reason of introduction of gift provision in the Income Tax Act. So, if you say that every year I am giving divorce to that same girl, every year I am getting married to that same girl, every year you would convert your black money into white without paying any taxes. So that cannot be acceptable. Dixit says, sir, politicians do on their birthday. The politicians on their birthday also they will receive gift. That is fully taxable. That is fully taxable. So I have explained you 2 points here. Gift received from a relative, gift received on the occasion of marriage is not taxable, but gift received on the occasion of marriage anniversary is taxable. Yes? So it is already 2 o'clock. So we need to wind up here.